Hello my dear students, so how are you all? I hope all of you are fit and fine. In this video we are going to start a new chapter and the name of the chapter is Public Finance. See, what is public finance? Public finance deals with the study of how the government raises the funds and how the government spends those funds. Okay, it is basically analyzing the government's expenditure, revenue, government revenue, and the public debt. Okay, so let's have a look on the overview of the chapter. Basically the overview of the chapter covers, that is what we are going to cover up in this particular chapter. So students, in this particular chapter we are going to cover up about the role of government in an economic system, that is the functions performed by the government in an economic system. Basically we are going to cover up the three major functions of the government performed in an economic system, and those are allocation function, redistribution function, and stabilization function. Also we are going to cover up about the center and state finance, that is we are going to cover up about the responsibilities of the central government and the responsibilities of the state government, and how the central government and state government manages their financial functions. Also, we are going to cover up the concept of market failure in detail. Basically, we are going to cover up the meaning of market failure and the reasons behind market failure, that is different sources of market failure, that is what leads to market failure. One of the example of the sources of market failure is imperfect information. Also, we are going to cover up what steps are being taken by the government in order to correct the market failure, that is various government interventions for correcting market failure. Along with this we are going to cover up the concept of government budget, that is the budget prepared by the government, along with the need and objectives of government budget, that is we are going to discuss about the aims which government achieve by making a government budget, and also we are going to discuss various budget concepts and terminologies like revenue expenditure, capital expenditure, revenue receipts, capital receipts, etc. Not only this, we are going to cover up the process of budget making also, that is the process which is involved in making the budget, or you can say in creating the budget. Also we are going to discuss the different sources of government revenue and expenditure, that is the sources of revenue generation by the government and the sources of expenditure by the government. Also we are going to discuss the process of management of public debt, that is the process by which the government manages its debt, okay, or you can say public debt. Along with this we are going to cover up the fiscal policy in detail. Under fiscal policy we are going to cover up the objectives of fiscal policy also, and the various instruments, or you can say the various tools of fiscal policy like taxation, revenue, etc. Along with this we are going to cover up the expansionary and contractionary fiscal policy. Basically we are going to cover up the meaning of expansionary and contractionary fiscal policy and when it is suitable to apply, etc. Also we are going to discuss about the limitations of fiscal policy. So this is all about the overview of this particular chapter. So students, let's recall whatever we are going to study in the chapter of public finance, that is overview of the chapter. The role of government in an economic system, that is the allocation function, redistribution function, and stabilization function. Next, center and state finance. Next, concept of market failure. Next, different sources of market failure and various government interventions for correcting market failure. Concept of government budget, need and objectives of government budget, various budget concepts and terminologies, process of budget making, different sources of government revenue and expenditure, the process of management of public debt, fiscal policy and its objectives, various instruments of fiscal policy, expansionary and contractionary fiscal policy, limitations of fiscal policy. So this is all about the overview of the chapter. Now students, let's start the chapter of public finance with its introduction. See students, we know that the government of all nations, that is the government of all countries, have important economic functions to perform. that is, the government of all countries have important functions to perform that leads to smooth running of the economy. Okay, economic functions are basically those functions of the government that is performed to ensure the smooth running of the economy. The government of all nations have to perform the economic functions even where the markets constitute the basic resource allocation mechanism. That is, even where the markets here means the private producers and entrepreneurs constitute the basic resource allocation mechanism. Here resource allocation mechanism means the mechanism, or you can say the way of distributing the resources. Or you can say factors of production in order to carry out the production of finished goods and services. For example, if there is a land, right? Now in this land we can prepare the rice and wheat, and for preparing the rice and wheat we will allocate the resources properly, right? We will allocate the labor that is specialized in generating the rice and wheat. Also we will ensure to allocate the seeds on this land which is for generating the rice and wheat, etc. Right? So the government of all nations have performed various economic functions even if the private producers and entrepreneurs are also working the same. Right? Basically the private producers and entrepreneurs are also doing the basic resource allocation mechanism. So it is not so that if private sector is working for the basic resource allocation mechanism or private sector is engaged in carrying out the economic functions, then government has no role to play for economic functions. It is not so. The government and the private sector together do the economic functions in order to carry out the smooth functioning of the economy and also constitute the basic resource allocation mechanism. Okay, in other words, the basic resource allocation mechanism is performed by the government as well as the private producers and entrepreneurs. Okay, so let's talk about the primary goal of the state. Here state means the government. Students, the primary goal of the government, or you can say the important goal or aim of the government, is to promote the general welfare of the society. That is to do the social welfare. That is the aim of the government, is to do the welfare, or you can say benefit of the people living in the society. Okay. For that, government opens the government schools, government hospitals in order to provide the educational services and medical services to the people living in the society, right? So that the benefit of the people can be done. Now let's recall it. The government of all nations have important economic functions even where markets constitute the basic resource allocation mechanism. Also, the primary goal of the state is to promote the general welfare of the society. Further, we have government at various levels, that is the government at the central level or the government at the state level, or you can say the central government and the state governments. Central and state governments involved in doing several operations. That is, central government and state government performs various operations, or you can say performs various activities in order to run the state and country. Okay. So for running of the state, government at various levels involves in several operations, like for example the government raises money from various sources. That is, the government generates some money from the taxes imposed on the goods and services and the taxes imposed on the income of people and companies, right? Like GST, income tax, corporate tax, etc. Also, the government raises the money in the form of fees and fines which is charged from the public. For example, the government charge the admission fee, OPD fees, right, etc. And also the government levies the fines on the lawbreaker, or you can say penalties on the lawbreakers, right? So there are various sources by which the government raises the money, and the government utilizes their funds, that is, does the expenditures on the construction of government schools, government hospital, government factories, government companies, etc. Right? So the government does the expenditure also. Next, the government consumes the goods and services also. For example, in the construction of school, the government hires a laborers, right? So the government is consuming the services of the laborers in order to construct the school, in order to get the school constructed. And also the government consumes various raw materials which are required in the construction of school, like cement, bricks, etc. And also the government borrows some money. That is, the government takes the loan from the public, from the foreign government, from the World Bank, etc. And also the government employs people. That is, the government provides job to the people, or you can say the government provides employment opportunities to the people in the government organizations like government schools, government hospitals, government factories, government offices, etc. So let's recall it. Government at various levels involve in several operations for running the state. For example, the government raises money from various sources, incurs expenditure, consumes goods and services, borrows money, and employs people, etc. Not only this, the government established, that is, the government frames, or you can say construct the rules and regulations in an economy in order to ensure the proper functioning of the economy. For example, the rule for the alcoholic seller is that the seller can sell the alcoholic products only after obtaining the license from the government. Now, not only the government establishes the rules and regulations, the government also ensures that these rules and regulations are properly executed and followed by the people living in the economy. That is, the government administers these rules and regulations. But still there are some matters which go unregulated. That is, there are some matters on which the government has not framed the rules and regulations, like the matters related to private relationships. Okay, that goes unregulated. So some aspects of private life are less regulated by the government. Okay, so let's recall it. The government establish and administer rules and regulations in the economy, but some matters still go unregulated. Similarly, most of the goods and services that we consume are provided exclusively by the government. For example, law and order. The services of law and order are provided by the government. The act of getting the patent right can be done through the government only, right? The government protects our intellectual assets by providing the patent right, which is exclusively provided by the government only. Private sector doesn't provide the patent right, right? And law and order, etc. So similarly, most of the goods and services that we consume are provided exclusively by government. And also the government is entering into that area where private sector will not enter. Like the government is producing those goods and services which will generate the social welfare, and the government is making those goods and services available to the people at very low prices. For example, the government is making the educational services available to the needy people at very low fees, right? And the government charges very less OPD fees for the medical services which are being provided by the government through its government hospitals, right? Further, students, there are three macroeconomic goals which every country wants to achieve, and that is economic growth, high levels of employment, and stable price levels. Now, what is economic growth? Economic growth occurs whenever the growth of real GDP of the economy is greater than the rate of population in that particular economy. Basically, whenever there is growth in the economy, that is whenever there is economic growth, the people enjoys higher level of standard of living. Also, the country wants to attain high levels of employment so that more output and more income can be generated for the people living in the economy. More output and more income can be generated. Also, students, none of the country wants to have unemployment, because the situation of unemployment in the economy not only creates loss for the unemployed people, that is they are not having the jobs and they people are not able to earn their income and fulfill their basic necessities of life, also it affects the economy as a whole negatively. How? With unemployment, less output can be generated, and whenever there will be less output generated, there will be less income generation in the economy, and this in turn going to affect all the people living in the economy, as a per capita income will reduce. Okay, and also the country wants to achieve stable price levels. As all of us know that inflation and deflation both are not good for the economy, right? Inflation and deflation. Neither the inflation nor the deflation is good for the economy. So every country wants to attain stable price levels. That is the constant price levels. Okay. So let's recall it till now. Macroeconomic goals for any nation. There are three macroeconomic goals for any nation, and those are economic growth, next high levels of employment, next stable price levels. Now students, here we need to note that the macroeconomic goals for any nation can be achieved with the proper functioning of the government in that particular nation. In a particular nation where the government is not intervening in the functioning of the economy, then that economy will not be able to attain these macroeconomic goals. So let's have a look. See students, the government does not expect the economy to function automatically, right? The economy will not function by its own. The government have to intervene it, right? So the government intervenes in order to give the directions about how to function the economy. And such intervention on the part of the government is based on the belief that the objective of the economic system is same as the objective of the government, that is to improve the well-being of individuals and households. Okay, so let's have a look. The government does not expect the economy to function automatically. Rather, it intervenes, that is it interferes to direct them to function in particular directions. Such intervention on the part of the government is based on the belief that the objective of the economic system and the role of the government is to improve the well-being of individuals and households. Now students, although we have gone through the role of government in an economic system, here we will do a quick recall of the role of government in an economic system. See students, we already know that our wants are unlimited, that is human wants are unlimited, and resources which are available to the society in order to fulfill their wants are limited, right? That is, the resources are less in order to fulfill our wants, right? So this arises the problem of scarcity. Scarcity of resources means the shortage of resources. Shortage of resources, right? That is, the supply of resources is less than the demand for the resources. Due to the shortage of resources, or you can say the scarcity of resources, an economy cannot produce all the goods and services that its member desire to have. Okay, so that's why the economy has to make the decisions about what to produce, how to produce, and for whom to produce. Okay, and how much resources should be set apart in order to do the economic growth or to enhance the productive capacity in the near future. So let's have a look. Role of government in an economic system. The basic economic problem of scarcity arises from the fact that wants are unlimited and resources available to the society are limited. An economy cannot produce all economic goods and services that its members desire to have. So, as just discussed that the scarcity of resources arises a need for decision making about what, how and for whom to produce and how much resources should be set apart to ensure growth of productive capacity. That is, an economic system which involves households, businesses and government makes the decision about how to allocate the resources, that is how to distribute the resources in order to do the production of products, and how to distribute these products should be done in order to get the answer of the basic questions like what, how and for whom to produce and how much resources should be set apart to ensure growth of productive capacity. So let's recall it. Therefore, an economic system in which a society, that is households, businesses and government, makes decisions about allocating resources to produce products and about distributing those products should exist to answer the basic questions like what, how and for whom to produce and how much resources should be set apart to ensure growth of productive capacity. Now students, we will go through the views of two economists, that is Adam Smith and Richard Musgrave, on the extent of the role of the government in the economy, basically on the desired extent of role of the government in the economy, or you can say the degree of desired governmental activity. Both of the economists were having the opposite thoughts on the degree of desired government activity in the economy. So Adam Smith was a strong favor of minimal governmental activity. That is, according to Adam Smith, the role of the government in an economy should be minimum. But it was not so with Richard Musgrave. According to Richard Musgrave, there should be maximum governmental activity in the economy. That is, the role of the government in an economy should be a great role in carrying out the economy. So let's go through in detail. Let's go through the views of Adam Smith first. See, Adam Smith was a bold advocate of free markets and minimal governmental activity. Here bold advocate means confidently supports. Confidently supports. So Adam Smith confidently supports the free markets, that is the markets in which the decisions are taken on the basis of demand and supply forces of the products. Decision making is done through price mechanism, and he confidently supports the minimal governmental activity. That is, according to Adam Smith, the role of the government in carrying out the economy should be minimum. Okay, so minimum role of the government should be there. Minimum role. Okay, Smith believed that government's role in society should be limited but well defined. According to him, the government role in society should be limited but it should be well defined. That is, the areas in which the government should play an active role should be well defined in the economy. So let's recall it till now. Adam Smith. Adam Smith is often described as a bold advocate of free markets and minimal governmental activity. Smith believed that government's roles in society should be limited but well defined. Now, according to Smith, the role of the government should be in the following areas like national defense in order to protect the security of the nation. Next, law and order. Law and order in order to give the justice to all the people, and establishment and maintenance of highly beneficial public institutions like government schools, government hospitals, and works where private sector doesn't come. Okay, so that is the works which will lead to the social welfare. For example, through government schools, the government will render the educational services to the students who could be deprived of the educational services if the government would not have provided the educational services at very less fees or free of cost. So the government should actively participate in the establishment, that is construction and setup and maintenance of highly beneficial public institutions, that is those institutions which are owned, controlled and managed by the government, and these institutions basically works for promoting the social welfare. And also the government should be the active part of the works or the task or the activities where the private sector doesn't come. Okay, like providing midday meal schemes to the students of government schools. Now let's recall it. According to Smith, the role of the government should be in following areas. First, national defense. Next, law and order. Next, establishment and maintenance of highly beneficial public institutions and works where private sector doesn't come. So this is all about the Adam Smith views on the role of the government. Now we will go through the views of Richard Musgrave on the role of the government. See students, the book, that is the Theory of Public Finance, it was published in 1959, was the book of Richard Musgrave. In his book, he described the role of the government in an economy, or you can say he described the role of the government in a market economy in a very detailed way. He basically introduced the three-branch taxonomy of the role of the government. That is, he divided the role of the government in a market economy into three branches, or you can say he divided the functions of the government to be performed in a market economy into three branches, and those were: first, resource allocation, that is distributing the resources in order to generate the goods and services in such a way that it will lead to less wastage of resources. That is, there should be optimal allocation of resources in the economy. Next, income redistribution, that is the income should be redistributed in a fair way in order to reduce the inequalities of income and wealth among the people living in the economy. Next, macroeconomic stabilization. Macroeconomic stabilization refers to stabilizing, that is preventing the frequent changes in the macroeconomic variables. Macroeconomic variables like employment, aggregate demand, aggregate supply, etc. So the government should focus on stabilizing the macroeconomic variables like employment, AD, AS, etc. So let's recall it till now. Richard Musgrave, in his book The Theory of Public Finance, which was published in 1959, he introduced the three-branch taxonomy of the role of the government in a market economy, and that includes resource allocation, income redistribution and macroeconomic stabilization. Now students, out of these three functions, allocation and distribution functions, or you can say redistribution functions, are a part of microeconomic functions, whereas stabilization is a macroeconomic function. Okay, so let's recall it. Allocation and distribution functions are primarily microeconomic functions, while stabilization is a macroeconomic function. So students, according to Richard Musgrave, there should be three functions of the government. Number one, resource allocation. Number two, income redistribution, or you can say the distribution function. Number three, macroeconomic stabilization, or you can say the stabilization function. So as we have already discussed that according to Richard Musgrave, there should be three functions which should be performed by the government in the economy, and that is the allocation function, next is the redistribution function, and the third one is the stabilization function. Now we are going to start the allocation function. We are going to discuss about the allocation function in detail. So let's have a look. See students, the allocation function is basically related to the allocation of resources in order to generate or construct the goods and services. Right? The distribution of resources should be done in such a way in order to avoid the wastage of resources. So the allocation function is related to best utilization of the available resources in order to generate the goods and services. So let's have a look. Resource allocation refers to the way in which the available resources or factors of production, that is land, labor, capital and entrepreneur, are allocated, or you can say distributed, among the various uses, or you can say various purposes to which they might be put. Okay, for example, there is a land. This is the piece of land. Now a farmer can generate rice or wheat or fruits on this particular piece of land, right? So this piece of land is a resource, and this resource can be used for various purposes. And now the farmer will decide about how to allocate the land or distribute the land in order to produce rice, wheat or fruits. Or if he want to use this land only for the cultivation of one crop, then he will take the decision about what to produce on this particular piece of land. That is, on land the rice should be produced, or wheat or fruits. Okay. So resource allocation is all about distributing the resource among the various uses to which they might be put. Okay. So it is a decision about the distribution of the resource. Not only this, the allocation function also involves determining how much of the various kinds of goods and services will actually be produced by using the available resources in an economy. For example, if a farmer will use this land for the cultivation of rice, wheat and fruits, then the farmer will also decide that how much quantity of rice, wheat and fruits will he grow on this particular piece of land. Okay. So allocation function also decides the quantity of various kinds of goods and services which will actually be produced in an economy. Okay. So let's recall it till now. The allocation function. Resource allocation refers to the way in which the available resources or factors of production are allocated among the various uses to which they might be put. It determines how much of the various kinds of goods and services will actually be produced in an economy. Now further we have that resource allocation is a critical problem. Why it is so? It is because there is scarcity of resources. Scarcity of resources. That is, the supply of resources is much less than the demand for resources. And also students, we require the resources in order to fulfill the human wants. But human wants are unlimited and resources are limited. That's why resource allocation is a very serious problem, or you can say critical problem. Because with resource allocation, we cannot produce all the goods and services which are desired to have by the people living in the economy. Next, also the economy should primarily focus on optimal or efficient allocation of scarce resources. That is, the economy should focus on utilizing the available resources in order to generate the goods and services in such a way that there is no wastage of the resources. That is, the resources of the economy which are scarce in nature should be utilized in an optimal or efficient way. That is, in a best way. So there should be optimal allocation of scarce resources, or you can say best allocation of scarce resources. So let's recall it till now. Resource allocation is a critical problem. One of the important functions of an economic system is the optimal or efficient allocation of scarce resources so that the available resources are put to their best use and no wastages are there. Now further we have See students, in an economy, the resource allocation is done by both the private sector and the public sector, that is government. But the aim behind the resource allocation done by the private sector and government sector is different. Private sector resource allocation is done by considering the profit motive, right? But government's allocation of resources is being done by considering the social welfare. So in real world, resource allocation is done by both the private and the government. So let's recall it till now. The private sector resource allocation is done by considering profit motives, and the government's allocation is done by considering social welfare. In the real world, resource allocation is done by both the private sector and the government. Also students, it is assumed that efficient allocation of available resources, that is optimal allocation of available resources in an economy, can be done only when there are markets which are perfectly competitive in nature. Or you can say, in case of perfectly competitive markets, the efficient allocation of available resources can be done. And also where the economic agents, that is consumers, producers, make rational choices, that is the sensible choices and sensible decisions. So where the economic agents makes the rational choices and decisions, efficient allocation of available resources can be done. But in reality, the markets can never be perfectly competitive, right? In reality, we have monopoly market, we have monopolistic competition market and oligopoly market. And also in reality, the economic agents, that is the consumers and producers, are not making the rational choices and are not taking the rational decisions. Every one of the economic agent considers their own interest without considering the social interest into mind while taking their decisions. So the efficient allocation of available resources is a big challenge for the economy to achieve. So let's have a look. Efficient allocation of available resources in an economy is assumed to take place only when the markets are perfectly competitive and economic agents make rational choices and decisions. In reality, markets are never perfectly competitive. Now students, we will discuss that why the allocation of resources should be done in an optimal way, or why there should be efficient allocation of resources in the economy. See students, if there is no efficient allocation of resources in the economy, that is market failure will occur. That is, the market will not be able to function properly due to inefficient allocation of resources. Now let's talk about the reasons behind market failures. So let's have a look on the market failures which hinders the efficient allocation of resources occur mainly due to. So there are several reasons behind market failure. Some of them are: first, presence of imperfect competition in the market. See students, as I've already told you that in real life we do not have the perfectly competitive market, and efficient allocation of resources is only possible in perfectly competitive market. So due to the imperfect competition in real life, that is due to the monopoly market, monopolistic competition market and oligopoly market, we are not able to attain the efficient allocation of resources. Let's talk about the monopoly. See students, in monopoly, the monopolist enjoys the monopoly power. That is, the monopolist is doing the underproduction of goods and also selling the goods at higher prices, which are above the marginal cost of the product. And also in all the markets there is underproduction. None of the market is producing the optimal quantity of goods and services, right? So all of this leads to market failure. So let's recall it till now. Market failures which hinders the efficient allocation of resources occur mainly due to imperfect competition and presence of monopoly power in different degrees, leading to underproduction and higher prices. As we know that monopoly power is also present in monopolistic competition and oligopoly market along with the monopoly market. But yes, the degrees of monopoly power present in different market forms are different. There is basically less monopoly power in monopolistic competition market and oligopoly market as compared to the monopoly power enjoyed by the seller in monopoly market. But yes, the sellers of all the markets, that is monopoly, monopolistic competition and oligopoly market, enjoys the monopoly power, which basically leads to underproduction and higher prices that would exist under conditions of competition. Next, let's look at the other reasons of market failure. See students, markets fail whenever the markets are not able to provide collective public goods to the people. Now what are collective public goods? Collective public goods are those goods which are consumed in common by all people living in the economy. Okay, and the use of the good by one person doesn't affect the use of the good by other person. Or you can say the use of the good by one person doesn't reduce the availability of the good to the other person. For example, defense, parks, etc. Okay. Next, whenever there is incomplete markets, that is the markets may fail to produce the right quantity merit goods. Now what are merit goods? Merit goods are those goods that will provide benefit to the people. For example, education and healthcare. So the market should provide the right quantity of merit goods to the people, but it is not so in reality, right? And also not only the market should provide the merit goods to the people, it should also be ensured that these merit goods are provided to the people at affordable rates. So let's recall it. Markets typically fail to provide collective public goods such as defense, which are by their very nature consumed in common by all people. Also, incomplete markets, that is markets may fail to produce the right quantity merit goods as education and healthcare. Now students, since there are some resources which are common property resources. Now what are common property resources? These are the resources which can be used by any person living in the society. For example, trees in the forest. Now let's take the example of the trees in the forest. See students, there is a forest. Here's a forest and these are the trees in this forest. Now since there is no rules regarding the cutting of the trees of this forest, so the people will try to get more of the trees as possible, right? The person will try to get more of the trees as much as possible from this forest. Let's suppose there is a person named Ram. Okay, he requires the wood of 2 trees only, right? Since it is available to Ram at free of cost, so Ram will take the wood of more than 2 trees rather than wood of 2 trees, right? So here in this case the resources are overused and exhausted in individual pursuit of self-interest. So common property resources leads to overutilization and exhaustion of the resources. Next we have externalities. See students, there are basically 2 types of externalities. One is positive externality and the another one is negative externality. Now let's understand what is externality. Externality means the action of one person creates positive benefits to the other person or the negative harmful effects for the other person. Let's talk about the positive externality first. See students, when the action of one person creates the benefits to the other person, okay, that is the example of positive externality. For example, the government makes the parks, right? And these parks are creating the benefits for the people, right? So government parks are the example of positive externality. And negative externality means the action of one person creates a harmful effect for the other person. For example, smoking by one person affects the people who are nearby when he was smoking, right? So smoking creates a negative externality. Also, the production by companies who are not using the eco-friendly methods creates damages to our environment. That is the negative externality, right? So students, positive externality is very good, but negative externality if created due to production and consumption of a good or service affect third parties. This leads to market failure because it harms the third parties, okay, who were not involved in the consumption and production of the goods. So let's have a look. Common property resources, for example environment, are overused and exhausted in individual pursuit of self-interest. Externalities which arise when the production and consumption of a good or service affect third parties. Also, factor immobility, that is, the factors of production are not perfectly mobile. Factors of production are not perfectly mobile. That is, the factors of production are not able to move from one sector to another sector easily. It basically leads to market failure because it creates unemployment and inefficiency in the market. See students, if we are not able to move the most efficient resources to the location where they are most needed, then it will definitely lead to market failure, right? And also the imperfect information. Now, if the sellers and the consumers are not having the perfect information about the product in which they deals in, then it would lead to market failure. As I have already told you, there is perfect allocation of resources when the economic agents, that is the consumers and the producers, are making the sensible choices and decisions, right? And it is only possible when they have the perfect information. But in case of imperfect information, that is lack of perfect information, the sellers and the consumers, or you can say all the economic agents, will not make the proper choices and decisions, which will lead to market failure, okay? And moreover, the market will fail due to inequalities in the distribution of income and wealth. See students, in an economy where there is unfair distribution of income and wealth among the people living in the economy, then it will lead to poor people are becoming more poorer and rich people are becoming more richer, which will result in enhancing the inequalities in the distribution of income and wealth, and ultimately the market failure will occur because in this particular situation the allocation of resources cannot be done perfectly. So let's recall it: factor immobility, which causes unemployment and inefficiency. Next, imperfect information, because it may not be in the interest of one party to provide full information to the other party. And also students, we know that in case of imperfect competition, the buyer can cheat the seller and the seller can cheat the buyer. So cheating can also take place in the marketplaces. And inequalities in the distribution of income and wealth. So due to the reasons of market failure, it is important for the government to intervene in the market so that the reasons behind market failure can be controlled by the government with its intervention, so that the market failure cannot occur and also the resources are allocated in a perfect way. There is no misallocation of resources, that is, the resources should not be allocated in such a way that will lead to production of certain goods too much, that is in large quantities, and whereas little production of certain other goods, that is production of other goods in very small quantities, okay? For example, the resources of allocation will not said to be the perfect allocation of resources if the society is using the resources to produce the demerit goods in large quantities like alcoholic products, cigarettes, etc. Demerit goods are those goods which will provide harm to the people who are consuming them. Okay, and less production of the merit goods like education, healthcare, etc. So let's recall it. In the absence of appropriate government intervention, market failures may occur. So in case of improper government intervention, market failures may occur. So the government should intervene properly in the market. And the resources are likely to be misallocated with too much production of certain goods. And the resources will likely to be misallocated with too much production of demerit goods or too little production of certain other goods, that is merit goods. For example, the society may produce too much of demerit goods and too little of merit goods. Also students, we know that the government provide us with those goods and services which we cannot produce on our own, or you can say we cannot buy at a price from the market. For example, law and order, patent rights, right? So let's recall it. The government can provide us with goods and services that we cannot produce on our own or buy at a price from the market. That is, the government provides us those goods and services which we cannot produce or purchase from the market by providing the price, right? And these are law and order and patent rights. Students, as I told you that externalities creates the negative effects and the positive effects, right? So based on that, there are basically two types of externalities, that is negative externalities and positive externalities. So the negative externalities creates the harmful effects for the other people. Harmful effects for the other people. And the positive externalities creates the benefit for the other people, right? But students, here we need to note that the harmful effects and the benefits which are created in the form of externalities are not considered in the prices. That is, let's suppose there is a factory. This factory is producing leather products. Okay. And the waste generated by this factory is disposed of in the nearby river. And the water of this river is consumed by the people who are living nearby. Consumed by people who are living nearby. And this is making the people ill. And they suffer from various disease due to the consumption of bad water. Various disease due to the consumption of bad water. Okay, and they are basically spending a lot of money on their to get recovered from these disease. They are basically giving high amount of fees to the doctor. Okay, and spending a lot of money on buying the medicines. On buying the medicines. And here we need to note that these negative effects which are done on the people are not considered while setting the price of the product. That is, the price do not reflect the true cost, right? And similarly, as the negative effects are not considered while setting the price, same as in case of benefits. So the benefits which are created out of positive externalities are also not considered while setting the price. So we can say that the price do not reflect the true cost and benefits. Okay. So externalities leads to market failure because the price do not reflect the true cost and benefits due to positive and negative externalities. So that's why there is a need for the government to intervene with appropriate corrective measures. So that's why the government interference is needed, and there is a need to take corrective actions by the government in order to consider these negative and positive effects in the prices which are charged for goods and services. Okay. And also students, merit goods which are greatly beneficial to the society are to be provided by the government to all the people living in the society. Okay. So the examples of merit goods are education, healthcare, etc. So let's recall it. When externalities are in the production and consumption of goods and services, price do not reflect the true cost and benefits, and government intervenes with appropriate corrective measures. Next, merit goods which are greatly beneficial to the society are by and large provided by the government. Also students, the production and consumption of demerit goods are controlled with appropriate policies. For example, the government charges high tax rates on demerit goods such as cigarettes and alcoholic products, so that the production and consumption of demerit goods are reduced in the economy, right? Also, the sale of demerit goods can be done with proper license from the government. So this is also one of the example of the policy that is levied by the government in order to control the production and consumption of demerit goods. Okay. So here I would like to focus you on the fact that these interventions by the government do not imply that markets should be replaced by the government action. That is, the markets should be operated by the government alone. No. But yes, in its allocation role, the government should act as a complement to rather than a substitute to the market system in an economy. So the government should work as complement with the private sector in order to smooth run the market system. Okay. So let's recall it till now. Production and consumption of demerit goods are controlled with appropriate policies. These interventions do not imply that markets are replaced by government action. In its allocation role, the government acts as a complement rather than as a substitute to the market system in an economy. Now students, we will discuss the allocative function of the government in budgeting. As we know that government prepares a budget in which the government shows its estimated expenditure and estimated revenue for the upcoming year, right? So while doing the budgeting, the government carries out its allocative function. Basically, the government's policies are focused on improving their economic performance. Okay, so the government policies focuses on the potential for the government to improve economic performance, and it is done through budgeting, that is its revenue and expenditure policies. So students, let's have a look on the allocative function in budgeting. So basically, the allocative function in budgeting determines who and what will be taxed, that is, to whom the government will levy the tax and on what goods and services the taxes should be levied. Next, how much and on what the government revenue will be spent. That is, the government will decide on what items the government will do the expenditure, that is, will spend his revenue. Okay, and how much amount. Okay. So let's recall it till now. The government's policy focuses on the potential for the government to improve economic performance through its budgeting, that is revenue and expenditure policies. The allocative function in budgeting determines A. Who and what will be taxed, B. How much and on what the government revenue will be spent. Further, we have the process by which the total resources of the economy are divided among various uses, that is the process of resource allocation. Process of resource allocation. Okay. Also, the government will decide the optimum mix of various social goods. That is, the government will decide the best combination. Here, optimum mix means best combination of both public and merit goods. Also, the government will decide the level of involvement of the public sector in the national economy. That is, the government will decide its level of involvement, that is its role in the national economy. So let's recall it. The process by which the total resources of the economy are divided among various uses. Next, the optimum mix of various social goods, both public and merit goods. Next, the level of involvement of the public sector in the national economy. Also, the government will decide the allocation of society's resources from private use to public use. That is, how the resources of the society should be transferred from the use of a private individual to use for all the people living in the society. So let's recall it, the allocation of society's resources from private use to public use. Now students, we will have a quick recall of the variety of allocation instruments that can be used by the government, or you can say the steps that can be used by the government for resource allocation, or you can say for optimal allocation of resources in the economy. Okay, so some of the steps are: the government may directly produce an economic good so that the government can provide the economic good to the people. For example, public transportation services and electricity are being provided by the government, and the government provides to the people living in the society. So let's recall it till now. A variety of allocation instruments are made available by which the governments can influence resource allocation in an economy. For example, the government may directly produce an economic good. For example, public transportation services, electricity, etc. Further, the government may direct resource allocation through incentives and disincentives. That is, the government may provide the incentives of tax concessions and subsidies on the production and consumption of merit goods. Tax concessions and subsidies on the production and consumption of merit goods, so that the production of merit goods can be increased in the economy. And the government will provide the disincentives like higher tax rates on the production of demerit goods in order to reduce the production of demerit goods in the economy. So through the incentives and disincentives policy of the government will do the optimal allocation of resources in the economy. Also, the government may influence allocation of resources through legislation and force, that is through legal system. The government will lead to proper allocation of resources. For example, the sellers of alcoholic products are allowed to sell the alcoholic products only when they are having the license. So before selling the alcoholic products, they have to take the license, that is a written permission from the government. So let's recall it till now. The government may direct resource allocation through incentives and disincentives. The government may influence allocation through legislation and force. Also, there are certain competition policies, merger policies, which are framed by the government in order to avoid the anti-competition activities in the market that leads to market failure. Okay, so the competition policies and merger policies also affect the structure of industry and commerce. So the competition policies and merger policies affect the structure of industry and commerce, that is the structure of trade and aids to trade and industry in the economy. And also the government, through its regulatory activities like licensing and control, affects the resource allocation. As I give you the example of selling the alcoholic products, right? For selling the alcoholic products, the seller requires a license. So let's recall it till now. The competition policies, merger policies, etc. affect the structure of industry and commerce. The government regulatory activities like licensing, controls, etc. affect resource allocation. So students, this is all about the allocation function. So we have just done the allocation function in detail. Now we are going to discuss about the redistribution function in detail. Now students, what is basically redistribution function which is performed by the government? See students, in a market where there is no government intervention, what will happen? Whatever income is created, whatever income is basically generated in the economy will be distributed in such a way that poor will become more poorer and rich will become more richer. That is, the income which is generated in the economy will be distributed among the people in such a way that it will increase the inequalities of income and wealth among the people living in the economy. Right. So the government should interfere in the distribution of income which is generated in the economy. Government should take the corrective actions in order to ensure that there is fair distribution of income in the economy. Fair distribution of income in the economy. Now, what is fair distribution of income? Fair distribution of income refers to the way of distributing the income in such a way that it reduces the inequalities of income and wealth among the people living in the economy. Right? And basically, it will lead to growth with equity in the economy if the distribution of income is fair in the economy, and the economy will prosper. So let's have a look in depth about the redistribution function. See students, the distribution responsibility of the government arises because if the distribution responsibility left to the market, that is the private players, then the distribution of income and wealth among individuals in the society is likely to be skewed. That is, the distribution of income and wealth among individual would be likely to be leaned towards the richer sections of the society. And therefore, the government has to intervene, or you can say interfere, in order to ensure socially optimal and egalitarian society. Now, what is socially optimal and egalitarian society? It is the society in which the benefits is created for all the people living in the society. For all the people living in the society. Moreover, in this society, all the people are considered equal. All people are considered equally, irrespective of their economic status, irrespective of their social status, etc. So, in order to create the socially optimal and egalitarian society, the government should intervene regarding the distribution of income in the economy. So, let's recall it till now. The redistribution function. The distribution responsibility of the government arises from the fact that left to the government, the distribution of income and wealth among individuals in the society is likely to be skewed, and therefore the government has to intervene to ensure a more socially optimal and egalitarian society. Now students, further we have that the distribution function of budget is related to the basic question, which is for whom should an economy produces goods and services. See students, whenever the production is done in the economy, right, the producer takes the help of four main factors of production, right, which is land, labor, capital, and entrepreneur, right. Now the income which will be generated after selling this output will be distributed among the landowner in the form of rent, among the laborers in the form of wages, among the capitalists in the form of interest, and among the entrepreneurs in the form of profit. Right. So, how much rent is to be provided to the landowner, how much wages is to be provided to the laborers, how much interest is to be provided to the capitalist, and how much share of profit is to be provided to the entrepreneur. So it is all about the allocating the income which is generated after selling the good or service which is produced. So distribution function of budget is related to the basic question that for whom should an economy produces goods and services. That whether the economy should produce the goods and services for the richer sections or for the poorer sections or for the middle class section of society. Basically, we know that our society is divided into three major sections, right? One is poor section, or you can say economically backward section. Another one is middle class section. That is the people having the moderate financial status, and rich people, or you can say rich section. So the distribution function of budget is related to the basic question for whom should an economy produces the goods and services. Whether the economy produces the goods and services for the poor section of people, or the economy produces the goods and services for middle class section, or the economy produces the services and goods for the rich section of people. Okay, let's suppose the society has decided to produce more of the luxury goods. That means the society has decided to produce for the rich people. And if the society has decided to produce more of the normal goods, that means the society has decided to serve middle class section people. And if the society has decided to produce more of the inferior goods, then that means the society has decided to produce for poor section of people. Okay, so the distribution function of budget is related to the basic question of for whom should an economy produces goods and services. Next, the government can redistribute income and wealth either through the expenditure side or through the revenue side of the budget. See students, the government can charge heavy taxes from rich people and can do the expenditure in order to provide the benefits to the poor people through the tax proceeds which the government has collected after levying taxes on the income of the rich people. Okay. For example, the proceeds of taxes from the rich people can be used for providing basic health facilities, basic educational facilities, and for implementing the PDS system, that is public distribution system, where the food grains are provided to the BPL families at very less prices, right? So the government can redistribute income and wealth either through the expenditure side or through the revenue side of the budget. Now students, further we have the aims of the distribution function of the government. That is the goals, or you can say objectives of the distribution function of the government. See, by performing the redistribution of income, the government want to attain the equitable distribution of societal output among people living in the society. Basically, with redistribution of income, the government wants to attain the distribution of societal output, that is the output which is produced in the society, among the people equally. Okay, and also the government wants to enhance the overall social welfare of the households. Okay, so let's have a look. Aims of the distribution function of the government. Redistribution of income to achieve an equitable distribution of societal output among people living in the society. Households ensuring increased overall social welfare. Further, the government wants to support the people who are deprived of certain needs. Let's suppose if the people are deprived of basic health facilities, the government has provided the basic health facilities to such people through their government hospitals, right? And for those who are deprived of the educational facilities, the government is providing the educational facilities to such people through government schools, right? So government is basically advancing, or you can say enhancing, the well-being, or you can say welfare of those members of the society who suffer from deprivations of different types. So let's have a look. Advancing the well-being of those members of the society who suffer from deprivations of different types. Now further we have, the government wants to attain the equality of income, wealth and opportunities. Government basically wants to create the egalitarian society where the equal opportunities are provided to all the people living in the society, right? And the distribution of income and wealth is done equally among the people living in the society. It is basically done fairly. Basically, providing equality of income, wealth and opportunities means ensuring that all the people are able to fulfill their basic necessities of life, like food, shelter and clothing. So let's recall it: providing equality of income, wealth and opportunities. So as already discussed, the government wants to ensure that all the people living in the society should fulfill their basic needs, or you can say must fulfill their basic needs, right? So government wants to provide the security to those people who are facing hardships, or you can say challenges, and the government ensures that everyone enjoys a minimum standard of living. So let's have a look. Providing security in terms of fulfillment of basic needs for people who have hardships and ensuring that everyone enjoys a minimum standard of living. Now further, there are few examples that we are going to talk about of the redistribution function performed by the governments. So here we have the progressive taxation policy. So as already discussed, the government levies higher rates of taxes on the income of the rich people, and from the proceeds of the taxes levied on the income of the rich people, the government is providing the subsidies to the poor households in order to support the people belonging to the poor section of society. So let's have a look. A few examples of the redistribution function performed by the governments are: progressive taxation policy with provision of subsidy to the poor households. Moreover, students, the proceeds that is government getting from progressive taxes levied by the government on the income of the rich people is used for financing the public services, that is for financing the services which is provided by the government to the people for social welfare. So what is the public services? Public services basically refers to those services which are provided by the government, to the public for social welfare. For example, PDS. Okay, under PDS, the government is providing food grains at very low cost to the people belonging to the poor families, or you can say to the BPL people, that is the people who are below the poverty line. Moreover, the government is keeping the employment reservations and preferences to protect certain segments of the population. For example, the people belonging to SC category and ST category and OBC category are provided the reservations, that is quotas, in getting the employment, right? Or you can say getting the quotas in terms of employment opportunities. So it is done by the government in order to protect those segments of the population. And also the government is levying the Minimum Wage Act, where the government is specifying minimum wages which need to be given to the labor in order to take his services for a day, right? So it is done in order to protect the interest of the laborers. Moreover, the government is setting the MSP for the farmers, that is minimum support price. This is done in order to ensure the interest of the farmers. So let's have a look. Proceeds from progressive taxes used for financing public services. Next, employment reservations and preferences to protect certain segments of the population. minimum wages and MSP for farmers. Moreover, the government is providing certain unemployment benefits like the unemployment allowance. Basically, the unemployment allowance is provided to the people under MG Narega scheme, and also the government is encouraging various transfer payments to provide support to the underprivileged, dependent, physically handicapped and the older citizens and the unemployed people. For example, old age pension. The government provides the old age pension to the people who belongs to the old age, who are basically above 60 years of age and they do not have anyone to take care of them. So let's recall it: unemployment benefits and transfer payments to provide support to the underprivileged, dependent, physically handicapped, the older citizens and the unemployed. Also, the families below the poverty line, that is the BPL families, are provided the monetary aid, that is a financial assistance in terms of money. Financial assistance in monetary terms, that is in money, or you can say in the form of money, and aid in kind, that is assistance in kind, that is assistance in the form other than money. For example, PDS. So let's recall it: families below the poverty line are provided with monetary aid and aid in kind. Also students, regulation of manufacture and sale of certain goods is being done by the government in order to ensure the health and well-being of consumers. For example, there is a rule that warning labels must be there. Warning labels must be there on cigarettes, which is like smoking is injurious to health, right? On every packet of cigarette, there is a label which is smoking is injurious to health. So it is one of the example of the regulation of manufacture and sale of certain products in order to ensure the health and the well-being of consumers. So let's recall it: regulation of manufacture and sale of certain products to ensure the health and well-being of consumers. Also, there are special schemes for backward regions and for the vulnerable sections of the population. Vulnerable sections means the dependent sections. Dependent sections. So the government has framed various special schemes for the backward regions and for the vulnerable sections of the population. For example, the government is focusing on the infrastructural developments in the rural areas. Okay. So this is one of the example of special schemes for backward regions. Also, the government is providing the tax rebates to the industrialists who want to set up their industries in the backward region. Also, the government is providing the license very easily and quickly to the industrialists who want to set up their industry in the backward regions. Okay, so through this the government is supporting the vulnerable sections of the population who belongs to the backward regions. So special schemes for backward regions and for the vulnerable sections of the population. Now students, when we exercise, or you can say implement the redistribution policies, then there is a conflict between the efficiency and equity. Let's have a look on the example. See, if the government is levying higher rates of taxes on the income of the rich people, then it will create a disincentive to the rich people for generating higher levels of income in the economy, right? Because he know that with the higher level of income generation, he has to give more tax to the government. So it might create a disincentive or demotivation among the entrepreneurs in enhancing their income. Okay, and ultimately it affects the societal output, income and growth. So here, while exercising the redistribution policies, the government should be conscious in order to reconcile the conflicting goals of efficiency and equity. So for that, the government should use optimal budgetary policy in order to reconcile the conflicting goals of efficiency and equity. So let's go through it. Exercising redistribution policies would create a conflict between efficiency and equity. Optimal budgetary policy can reconcile the conflicting goals of efficiency and equity by exercising an appropriate trade-off between them. So I hope students the redistribution function is clear to you. So till now we have discussed about the allocation function and redistribution function. Now we are going to discuss about the stabilization function. Now students, what is stabilization? Stabilization is basically the balance. Okay, here the stabilization relates to the balance of the entire economy, and we know that the entire economy is based on basically aggregate macroeconomic tools, okay, such as output, production, consumption, prices, etc. So the economy will be balanced, or you can say the economy will be in stabilization situation only when the aggregative macroeconomic tools such as output, production, consumption, prices are in balanced situation. So if we want to create the economy in stabilization situation, or you can say if we want to create a stable economy, then we should focus on having stable aggregate macroeconomic tools such as output, production, consumption, prices, etc. Okay, so stabilization function is basically the function relates to bringing the stabilization in the economy. So let's have a look. See students, the macroeconomic stability is said to exist when the economy's output, or you can say when the economy's actual output, or you can say the output which is actually created in the economy is equal to its production capacity. In other words, we can say that the macroeconomic stability will exist whenever the economy's output matches its production capacity. Similarly, macroeconomic stability will set to exist whenever the economy's total spending, or you can say the economy's total expenditure, will be equal to the economy's total output. In other words, we can say that whenever the entire output which is generated in the economy will be sold out, then we can say that there is economic stability. Next, the economic stability is said to exist whenever there is full employment of labor resources. That is, there is no unemployment existing in the economy. Next, whenever the inflation is low and stable. That is, whenever the inflation in the economy is up to 2%. Okay, that is, the inflation in the economy is low and stable, then we can say that macroeconomic stability is there. Here we need to note that students, a little inflation, that is the inflation up to 2%, is good for the economy. So a low inflation should be there in order to promote the economic growth. So macroeconomic stability only exists whenever there is low inflation going on in the economy. That is, the inflation is up to 2% in the economy. So let's have a look. Macroeconomic stability is exist when economy's output is equal to production capacity. Next, economy's total spending is equal to total output. Next, economy's labor resources are fully employed. Next, inflation is low and stable. Next, students, we will talk about why there is a need for the government to interfere in order to bring the stability in the economy. So we are going to talk about the government's interference, or you can say need of government interference to bring the stabilization in the economy. See students, according to Keynesian proposition, according to Keynes, a market economy doesn't automatically generate full employment and price stability, right? If we want to have full employment and price stability, then the government should pursue deliberate stabilization policies. That is, the government should implement the stabilization policies. Okay. So let's have a look. Government's interference. According to Keynesian proposition that a market economy does not automatically generate full employment and price stability, and therefore the government should pursue deliberate stabilization policies. Next students, here we need to note that how the government brings the stabilization in the economy. See, basically the government and the central bank brings the stabilization in the economy. the government and the central bank, that is RBI in India, promote full employment and price stability through their policies, that is fiscal policy and monetary policy. We know that fiscal policy is basically the policy used by the government in order to promote full employment and price stability in the economy by altering the tax rates and the public expenditure. And monetary policy is the policy used by the Central Bank of India, that is RBI, in order to bring full employment and price stability in the economy by altering the money supply, or you can say by changing the money supply in the economy. Okay, so let's have a look. The government and the central bank promote full employment and price stability through fiscal policy and monetary policy. Further, students, what will happen if there will be no appropriate corrective intervention by the government in the economy in order to bring the stabilization in the economy? Then the instabilities, okay, in the form of recessions, inflation, deflation, etc. will be seen in the economy. And you know, students, if recession and inflation will exist in the economy for longer periods, then it will lead to enormous hardships to people, especially the poorer sections of the people will suffer huge amount of sufferings. Okay, so let's have a look. In the absence of appropriate corrective intervention by government, the instabilities that occur in the form of recessions, inflation, etc. may be prolonged for longer periods, causing enormous hardships to people, especially the poor sections of the society. Further, students, you know, the stagflation may arise in the economy. Now, what is stagflation? Stagflation is a situation which includes the inflation along with extreme unemployment. Extreme unemployment. Okay, so this is the adverse situation for the economy, where an economy faces the inflation along with the extreme level of unemployment in the economy. Instabilities are contagious. Now, what is this? Instabilities are contagious. It means that the instabilities arising in the one country will affect the other countries to whom it is related through international trade. Okay, so we can say that instabilities are basically having the contagion effect. Okay, so let's have a look. Stagflation may arise in the economy. Instabilities are contagious, that is contagion effect. Now, students, the stabilization function is concerned with the performance of the aggregate economy in terms of labor employment. Basically, the stabilization function focuses on full employment of labor resources of the economy and proper utilization of capital. That is the capital utilization. Moreover, the stabilization function focuses on the overall output and income generation in the economy. Basically, the stabilization function ensures that there is proper generation of output and income in the economy, and moreover, the income is distributed in a fair manner. Okay, that is, the income is distributed in such a manner that it reduces the inequalities of income and wealth among the people living in the economy. Next, it is concerned with general price levels also. The stabilization function focuses on having the price level which is not promoting the inflation nor the deflation. Next, the stabilization function on bringing balance in the international payments of the country. Okay, so it basically focuses on balancing the BOP account of the country. Next, the stabilization function focuses on generating high rate of economic growth. Okay, so let's have a look. The stabilization function is concerned with the performance of the aggregate economy in terms of labor employment and capital utilization, overall output and income, general price levels, balance of international payments, rate of economic growth. Now, students, we will talk about the government stabilization measures, that is the steps taken by the government in order to bring stabilization in the economy. See, students, as I told you that the government uses the fiscal policy, or you can say the tools of the fiscal policy, that is the taxation and the public expenditure, in order to bring stabilization in the economy. Basically, the fiscal policy can be of two forms. One is expansionary fiscal policy and the another one is contractionary fiscal policy. In case of high deflation, the government uses a expansionary fiscal policy, and in case of high inflation, the government uses a contractionary fiscal policy in order to control the high inflation prevailing in the economy. Now, what does the government do under expansionary fiscal policy? See students, under expansionary fiscal policy, the government reduces the tax rates, okay, and government increases the public expenditure in order to control the deflation in the economy, okay, and vice versa in case of contractionary fiscal policy. Under contractionary fiscal policy, the government raises the tax rates and the government reduces the public expenditure in order to bring the stability, in order to control the high inflation prevailing in the economy. So let's have a look. Government stabilization measures. Fiscal policy. There are basically two main tools of fiscal policy. One is taxation, another one is public expenditure. And there are basically two forms of fiscal policy, that is expansionary fiscal policy, which is used in case of high deflation in order to control the high deflation in the economy, and another one is contractionary fiscal policy, which is used in case of high inflation prevailing in the economy in order to control it. Now students, we will talk about the central bank measures in order to bring stability in the economy. Now, in order to bring the stability in the economy, the central bank uses its monetary policy. Okay, through its monetary policy, the central bank basically controls the size of money supply in the economy, and the central bank controls the interest rate in the economy, okay, which in turn would lead to affect the consumption, investment, here invested means investment, and prices. Okay, so in order to bring the consumption stability, in order to bring the investment stability, in order to bring the price stability prevailing in the economy, the central bank focuses on controlling the size of money supply and the interest rate prevailing in the economy through its monetary policy. So let's have a look. Also students, government through its budgetary policy, or you can say with the help of budgets, the government can promote the price stability in the economy. Price stability in the economy. How? See students, in case of deflation, the government uses the deficit budget in order to control the deflation. Okay, and in case of inflation, the government uses a surplus budget in order to control the inflation. Okay, under deficit budget, basically public expenditure is increased. Okay, and under surplus budget, the public expenditure is decreased. Okay, so by altering the public expenditure or through budgets, the government can bring price stability in the economy. So let's have a look. Government's budget. Basically, deficit budget is used in order to control the deflation in the economy, and vice versa. That is, surplus budget is used in order to control the inflation in the economy. Okay, now what is deficit budget, surplus budget, why it is used, how it is effective in controlling the deflation and inflation of the economy? We will study this in the further videos. Okay. Now we will talk about the central bank's measures. Now we will talk about the steps taken by the central bank in order to bring the stability in the economy. So basically, the central bank uses a monetary policy in order to bring the stability in the economy. Now, how the monetary policy is effective in bringing the stability in the economy? See students, through monetary policy, the central bank basically controls the size of money supply in the economy, and also the central bank controls the interest rate in the economy. Okay, which in turn will bring the stability in consumption, investment, and prices in the economy. Now, how the monetary policy is effective in bringing the stability in consumption, investment, and prices, we will study this in our next chapter in detail. Okay, so as if now, just we need to remember that central bank brings the stability in the economy in terms of consumption, investment, and prices by implementing its monetary policy, and through monetary policy, the central bank basically controls the size of money supply and interest rates prevailing in the economy. So let's have a look. Central bank's measures. Monetary policy basically controls the size of money supply and interest rate in the economy. which in turn would affect consumption, investment and prices. Now students, we will talk about the center and state finance. Basically, we are going to talk about the responsibilities of the central government and the state government in financial aspect. That is, we are going to talk about the financial responsibilities of the central and the state government. Okay, so let's have a look. See students, we will first talk about the fiscal federalism. Okay, now what is this? This is a term which was given by Richard Musgrave. Okay, this is basically relates to the division of financial responsibilities and powers between different levels of government. That is the central government, state government and local government. Okay, or we can say different levels of government such as government at central level or government at state level or government at local level within a country. Okay, so what is fiscal federalism? It is basically allocating the financial responsibilities and powers among different levels of the government, okay, within a country. So let's have a look. Fiscal federalism. It is a term given by Richard Musgrave. It refers to the division of financial responsibilities and powers between different levels of government within a country. For example, who will levy the income tax, who will levy the corporate tax, who will levy the GST is basically a part of fiscal federalism. Now students, in other words, we can say that fiscal federalism involves the allocation, or you can say distribution of taxation and spending authority. That is the distribution of the taxation authority, that is the power related to the taxation policy, and the spending authority, that is the expenditure power, okay, to federal, state and local governments to achieve economic and political objectives while maintaining a balanced distribution of resources. Okay, why we focus on fiscal federalism? We basically focus on fiscal federalism so that we can attain the economic and political objectives by maintaining a balanced distribution of resources among the central government and the state government and the local government. So let's have a look. It involves the allocation of taxation and spending authority to federal, state and local governments to achieve economic and political objectives while maintaining a balanced distribution of resources. Next, according to Richard Musgrave, central government or federal government should be responsible for performing functions related to economic stabilization and income distribution. And the allocation of resources, that is the distribution of resources, should be the responsibility of the state and the local government. So let's have a look. According to Richard Musgrave, central government or federal government should be responsible for performing functions related to economic stabilization and income distribution, and the allocation of resources should be responsibility of the state and local government. Further, we have Constitution of India. So students, the Constitution of India also has provided the division of powers between the central and the state governments. Basically, Article 246 defines the powers of the union and the state government by classifying their powers into three lists. First is union list, another one is state list, and the another one is concurrent list. So let's recall it till now. Constitution of India. The Constitution of India has provided for the division of powers between the central and the state governments. Article 246 demonstrates the powers of the union and the state by classifying their powers into three lists: union list, state list and concurrent list. Okay. Students, under union list, items which are placed are those on which central government can legislate. Okay. And state list involves those items on which state government can legislate. That is, under union list, there are those items on which central government can frame the laws. Okay. Or you can say on which central government has the power. And state list involves those items on which state government can legislate, that is, state government can have the power. Okay. So let's have a look. Union list, items on which central government can legislate. State list, items on which the state government can legislate. And what about the concurrent list? Concurrent list basically involves those items on which the parliament as well as the legislative assemblies can legislate. It basically includes those items on which the central government as well as the state government can legislate. Okay, but in case of any conflicting legislation, the law passed by the center government, or you can say central government, will prevail. Okay, so let's have a look. Concurrent list, items on which both the parliament and the legislative assemblies can legislate. In case of conflicting legislation, the law passed by the center government will prevail. Next, students, in India, taxes are basically levied by the center and states. That is, taxes are levied by the central government as well as the state governments. Central governments can levy taxes such as tax on income other than agricultural income, customs and export duties, excise duties on certain goods, corporation tax, etc. Also, the central government can levy tax on capital value of assets, excluding agricultural land, terminal taxes, security transaction tax, central GST, union excise duty, and taxes other than stamp duties, etc. So let's recall it till now. Taxes are levied by the center and states. Central government can levy taxes such as tax on income other than agricultural income, customs and export duties, excise duties on certain goods, corporation tax, etc. The central government can levy tax on capital value of assets, excluding agricultural land, terminal taxes, security transaction tax, central GST, union excise duty, taxes other than stamp duties, etc. Now, students, we will talk about the taxes which are levied by the state governments. The state governments can levy taxes on agricultural income, lands and buildings, mineral rights, electricity, vehicles, tolls, professions, and they can also collect land revenue and impose excise duty on certain items. So let's have a look. The state governments can levy taxes on agricultural income, lands and buildings, mineral rights, electricity, vehicles, tolls, professions, collect land revenue and impose excise duties on certain items. Also, students, here we need to note that the property of the union is exempt from state taxation, and also the property and income of the states are not liable to be taxed by the center. Okay, that means the state government cannot levy any tax on the property of the union. Similarly, the union government cannot impose the tax on the property and the income of the state governments. So let's have a look. The property of the union is exempt from state taxation. The property and income of the states are not liable to be taxed by the center. Further, students, we will talk about the another element of fiscal federalism, which is the most important element, or you can say component of fiscal federalism, which is intergovernment transfers and revenue sharing. Basically, the central government and the state government shares the revenue of the taxes which is being levied and collected by the central government. Okay, so in our constitution, the article 268 to 281 of the constitution contains specific provisions in respect of distribution of finances among states. Okay, so let's have a look. An element of fiscal federalism, that is intergovernment transfers and revenue sharing. Article 268 to 281 of the Constitution contains specific provisions in respect of distribution of finances among states. So here are some of the constitutional provisions related to the taxation or the grants or loans by the public for public expenditure. Okay. So here Article 268 relates to the duties levied by the union but collected and appropriated, or you can say distributed, by the states. Whereas Article 269 relates to the taxes levied and collected by the union, that is the central government, but assigned to the states. Okay, but the task is assigned to the states, or you can say states government. So let's have a look. Constitutional provisions. Article 268. Duties levied by the union but collected and appropriated by the states. Next, Article 269. Taxes levied and collected by the union but assigned to the states. Next, Article 270. Article 270 is related to the taxes levied and collected by the union government and distributed between the union and the state governments as prescribed in clause 2 and the states. Okay, and Article 271 is basically related to the surcharge on certain duties and taxes for purposes of the union government. Okay, so let's recall it till now. Article 270, taxes levied and collected by the union and distributed between the union and states as prescribed in clause 2 and the states. Article 271 is related to surcharge on certain duties and taxes for purposes of the union. Article 275 is related to the statutory grants and aid from the union to certain states. And Article 282 is related to grants for any public purpose. So let's recall it. Article 275, statutory grants and aid from the union to certain states. Article 282 is related to grants for any public purpose. Next, Article 293 is related to loans for any public purpose. So let's recall it. Article 293 is related to loans for any public purpose. Now students, we will talk about the unique feature of the Indian Constitution. Article 280 provides for institutional mechanism, namely the Finance Commission, in order to facilitate intergovernment transfers. Okay, basically Finance Commission is there to support and to help in intergovernment transfers. So let's recall it. Unique feature of the Indian Constitution. Article 280 provides for any institutional mechanism, namely the Finance Commission, to facilitate intergovernment transfers. Students, now we will go through the role of Finance Commission, or you can say functions of Finance Commission. Okay, so Finance Commission is responsible for evaluating the state of finances of the union and the state governments and also recommending the sharing of taxes between them. Okay, that is recommending the distribution of the tax revenue between the union and the state government. And also it is responsible for laying down the principles determining the distribution of these taxes among states. So let's recall it. It is responsible for evaluating the state of finances of the union and state governments, recommending the sharing of taxes between them, and laying down the principles determining the distribution of these taxes among states. Further, we have the distribution between the union and the state government of the net proceeds of the taxes which are to be divided between them, and the allocation between states of the respective shares of such proceeds. Okay, so let's recall it. The distribution between the union and the states of the net proceeds of taxes which are to be divided between them, and the allocation between states of the respective shares of such proceeds. Also determining of principles and quantum of grants and aid to state governments which are in need of such assistance. Okay, so basically it is a Finance Commission which determines, or you can say which decides the principles and the quantum of grants and aid, that is the amount of grants and aid to the state government which are in need of such financial assistance. So let's recall it. Determination of principles and quantum of grants and aid to states which are in need of such assistance. Also students, Finance Commission is responsible to make recommendations to the President on measures needed to augment the consolidated fund of a state to supplement the resources of the panchayats and municipalities in the state on the basis of the recommendations made by the Finance Commission of the state. Okay, so basically the recommendations, or you can say the suggestions, are made by the Finance Commission to the President on steps needed to consolidate, to augment, or you can say support the consolidated fund of a state, to support the resources of the panchayat and municipalities in the state on the basis of the recommendations made by the Finance Commission of the state. Okay, so let's recall it. To make recommendations to the president on measures needed to augment the consolidated fund of a state, to supplement or support the resources of the panchayats and municipalities in the state on the basis of the recommendations made by the Finance Commission of the state. Also students, any other matter referred to the commission by the president in the interest of sound finance. So Finance Commission is basically a body which takes the sound financial decisions. So if in case the president of the country requires any financial advice, then he refer the Finance Commission and the Finance Commission provides the advice. So any other matter referred to the commission by the president in the interest of sound finance. Now students, there are some issues or you can say problems faced by the Finance Commission, and those problems are vertical equity and horizontal equity. So vertical equity and the horizontal equity are the problems faced by the Finance Commission in distributing the revenue of the taxes among the central government and the state government, or in providing the recommendations regarding that. So basically what is vertical equity? It is basically deciding about the share of all states in the revenue collected by the center. Okay, so the Finance Commission faces the problem for deciding the share of all the state governments in the revenue, or you can say tax revenue collected by the central government. Another we have is horizontal equity. Horizontal equity is about allocating or deciding among the states their share of central revenue. Okay, it is basically the issue which is related to distributing the share of the central revenue among the states. So let's have a look. Issues faced by the Finance Commission. Vertical equity, that is deciding about the share of all taxes in the revenue collected by the center. Next is horizontal equity, that is allocating among states their share of central revenue. Here we need to note some points. 15th Finance Commission was constituted on 27th November 2017. Okay, and what did it recommended? The 15th Finance Commission recommended that the share of states in the central taxes for the year 2021 to 2026 is to be 41%, which was less than 42% recommended by the 14th Finance Commission for the years 2015 to 2020. Okay. Now, here we need to note that the decrease in 1% is what? There is adjustment of 1% which is provided to newly formed union territories of Jammu and Kashmir and Ladakh from the resources of the center. Okay. So let's have a look. The 15th Finance Commission was constituted on 27th November 2017. The 15th Finance Commission recommended the share of states in the central taxes, that is vertical devolution, for the year 2021 to 2026 to be 41%. That is less than 42% recommended by 14th Finance Commission for 2015 to 2020. The adjustment of 1% is to be provided for newly formed union territories of Jammu and Kashmir and Ladakh from the resources of the center. Now students, we will talk about the criteria for distribution of central taxes among states for 2021 to 2026. So the criteria was income distance, that is the distance of the state's income from the state with the highest income. Or you can say income distance is referred to as the difference of the income of the state from the state with the highest income, with the highest area, population and demographic performance. Demographic performance was judged in order to reward efforts made by the state in controlling their population. Okay. Also forest ecology and tax and fiscal efforts. So income distance that is the distance of the state's income from the state with the highest income, area and population. Demographic performance, that is to reward efforts made by states in controlling their population, forest, ecology and tax and fiscal efforts. Now students, we will talk about the GST. GST stands for Goods and Services Tax. Goods and Services Tax. We all know that it is an indirect tax which is levied on goods and services. With the introduction of GST, the GST has replaced, or you can say subsumes, the majority of indirect taxes such as excise services tax, sales tax, octroi, that is entry tax, right? The GST has made India's indirect tax regime, that is India's indirect tax system, unitary in nature. That is, the rates of GST are same in all the states of India, right? So it is basically a uniform indirect tax system which is prevailing in India. GST was implemented in India on 1st July 2017. From 1st July 2017. So let's recall it till now. GST, indirect tax levied on goods and services. The GST has made India's indirect tax regime unitary in nature. The GST subsumes the majority of indirect taxes, that is excise services tax, sales tax and octroi, that is entry tax. The GST was implemented on 1st July 2017. Now students, here we need to note that there are basically three components of GST, that is CGST, Central GST, SGST, that is State GST, IGST, that is Integrated GST. Okay. So students, whenever there is intrastate movements of goods and services, that is the goods and services are purchased and sold within the same state, that is intrastate movement of goods and services, CGST and SGST is levied. Okay. And whenever there is interstate movement of goods and services and cross-border movement of goods and services. Now it is interstate movement of goods and services, that is the goods and services are being purchased and sold in another state. Okay. And there is cross-border movement, that is there is import and export of goods and services. Then in case of interstate movement of goods and services and cross-border movement of goods and services, IGST is levied, that is integrated GST is levied. Basically integrated GST is the combination of CGST and SGST. So let's recall it. GST, intrastate movement of goods and services. On intrastate movement of goods and services, CGST and SGST is levied, whereas on interstate movement of goods and services and cross-border movement of goods and services, IGST is levied. Now here we have states levy and collected state GST. Okay, the revenue which is arising from SGST is basically goes to state, and states levy, that is impose and collect the state GST, whereas central government levy and collect central GST, that is CGST. So let's recall it till now. States levy and collected state GST, that is SGST, and central government levy and collect central GST, that is CGST. Also, if we talk about integrated GST, integrated GST is applied on interstate movement of goods and services, as we already discussed, and on import of goods and services. So let's have a look. An integrated GST, that is IGST, is applied on interstate movement of goods and services and on import of goods and services. Also students, as already discussed, IGST is basically a combination of SGST and CGST. It is basically administered and collected by the central government, and it is kept in a separate account and distributed between the union and state governments. Okay, so let's recall it. IGST is a combination of SGST and CGST, administered and collected by central government, kept in a separate account and distributed between the union and states. Here we need to note that students, GST accounts for 35% of the gross tax revenue, that is the total tax revenue of the union government, and around 44% of own tax revenue of the state government. So let's recall it. GST accounts for 35% of the gross tax revenue of the union and around 44% of own tax revenue of the states. Now students, who forms the laws on GST? See, as per the Supreme Court verdict in May 2022, that is as per the order given by the Supreme Court in May 2022, the union and the state legislatures have equal and unique powers regarding making laws on GST. Okay, so basically the central government and the state government have the equal powers and the unique powers about making laws on GST, and the recommendation of GST Council are not binding on them. Okay, they are not bound to follow the recommendations made by the GST Council on GST. Okay, so let's recall it. Laws on GST. As per the Supreme Court verdict in May 2022, the union and state legislatures have equal and unique powers regarding making laws on GST, and the recommendations of GST Council are not binding on them. Now students, we will talk about the implementation of cess. Now before going through the implementation of cess, we should know the meaning of cess properly. Now what is cess? Cess is basically a tax which is levied for a specific purpose. Like it can be for funding a specific project. Okay, so cess is basically a tax which is imposed for a specific purpose. So students, with the origin of GST system in India, the prevailing production based tax system came to an end, right? And what is basically production based tax system? That is the state in which the production of goods and services will be done, the tax will be levied over it, and the revenue out of that will go to that state government of the state in which the production of goods and services has been done. Okay, but GST is basically consumption based tax. That is, the revenue of the tax goes to the state government in which the consumption of goods and services has been done. Okay, so it has resulted in loss of tax revenue to the governments of manufacturing states. So in order to recover the loss of tax revenue to the governments of manufacturing states, cess has been implemented in India. Okay, so let's recall it. Implementation of cess. The GST system replaced the prevailing production tax based system with a consumption based tax. It led to loss of tax revenue to the governments of manufacturing states. It was decided to provide compensation to states for loss of revenue at least for the period of 5 years from the date of its implementation. Okay, so it was decided to provide compensation to states for loss of revenue for the period of 5 years from the date of its implementation. So students, cess is being levied for providing compensation to states, and a cess is levied on some luxury goods, that is the status symbol goods, and demerit goods, that is the goods which reduces the welfare of the people living in the society. And the proceeds are credited to the compensation fund. Okay, so basically the proceeds of cess are credited to the compensation category under the compensation fund. Okay, later on GST compensation was extended beyond 5 years because of the losses which were faced by the state governments due to the pandemic of COVID-19. Okay, so in order to make the recover of those losses for the state government, the GST compensation was extended beyond 5 years. So let's recall it. For providing compensation to states, a cess is levied on some luxury goods and demerit goods. The proceeds are credited to the compensation fund. Later on, GST compensation was extended beyond 5 years to enable states to recover the losses caused due to pandemic. Now students, let's talk about the top 5 GST compensation receiving states. See, during the 5-year transition period, there were the top 5 GST compensation receiving states were Maharashtra, Gujarat, Tamil Nadu, Karnataka and Punjab. Okay, so let's recall it. Top 5 GST compensation receiving states. During the 5-year transition period, the top 5 GST compensation receiving states are Maharashtra, Gujarat, Tamil Nadu, Karnataka, Punjab. Now students, let's talk about the total amount of compensation which is released to the states and union territories during the year 2022 to 2023. So the amount was rupees 1,15,662 crores. So let's recall it. The total amount of compensation released to the states and the union territories during the year 2022 to 2023 is rupees 1,15,662 crores. Now students, we will talk about the expenditure decentralization. That is the expenditure responsibilities among central government, state government and the local government. So the central government is basically provided with the responsibilities of provision of nationally important areas like defense, foreign affairs, foreign trade and exchange management, money and banking, cross-state transport and communication. Okay, so let's recall it. Expenditure decentralization. The central government is entrusted with the responsibilities of provision of nationally important areas like defense, foreign affairs, foreign trade and exchange management, money and banking, cross-state transport and communication. And the state governments are provided with the responsibility of facilitating agriculture and industry sector, providing social sector services such as health and education, police protection, state roads and infrastructure. So let's recall it. The state governments are entrusted with responsibility of facilitating agriculture and industry, providing social sector services such as health and education, police protection, state roads and infrastructure. Now we will talk about the local self-government's responsibilities. The local self-governments such as municipalities and panchayats are given the responsibility of providing public utility services such as water supply, sanitation, local roads, electricity, etc. So let's recall it. The local self-governments such as municipalities and panchayats are entrusted with the responsibility of providing public utility services such as water supply and sanitation, local roads, electricity, etc. And for items that fall in the concurrent list, both the central and the state governments are responsible for providing services. So let's recall it. For items that fall in concurrent list, both central and state governments are responsible for providing services. Okay students, so I hope this section is clear to you. Students, we are going to start a new topic of this chapter, which is market failure. With market failure, most of the students think that market doesn't work at all, or you can say market doesn't function at all, but it is not so. With market failure, we mean that market is not working properly. Market is not working properly. Basically, market failure means market do not function, or you can say work in the way it should be. Okay, basically market failure occurs whenever the market fails to allocate the resources of the economy properly in order to carry out the production. So basically market failure occurs whenever there is misallocation of resources of the economy. That is, whenever the market fails to distribute the resources of the economy properly in order to carry out the production of goods and services. Basically, there is inefficient utilization of resources. That is, there is wastage of resources. Okay. So, market failure. What is the root cause of market failure? The root cause is basically misallocation of resources which are scarce in nature. Okay. Now, let's understand the meaning of market failure in detail. See students, market failure is a situation in which the free market leads to misallocation of resources. Okay, that is, whenever there is misallocation of resources in the market, then the market fails. In the sense that there is either overproduction or underproduction of particular goods and services. Due to that, the market doesn't operate at optimal level, or you can say the market is not able to produce the optimal output. Okay, what is overproduction? Overproduction means the production of certain goods and services are more than the demand of those goods and services in the economy. And underproduction means the production of goods and services is less than the demand of those goods and services in the market. That is, the production of such goods and services are not able to meet the demand of the consumers in the market. Okay, so let's recall it. Market failure is a situation in which the free market leads to misallocation of resources, in the sense that there is either overproduction or underproduction of particular goods and services, leading to a less than optimal output. So basically, market failure is that the market is not able to operate, or you can say generate, optimal output because there is misallocation of resources, which leads to either overproduction or underproduction of certain goods and services. Students, this is all about the meaning of market failure. Now let's talk about the types of market failure. There are basically two types of market failure, and those are, first, complete market failure, and the another one is partial market failure. So complete market failure and partial market failure are basically two categories, or you can say types of market failure. Now let's understand what is complete market failure. See students, under complete market failure, there are basically missing markets for the product. Missing markets. That is, the markets do not produce the product at all, despite of the fact that people need those products. Okay, or you can say the markets do not supply the product at all, even if the people needs that product. For example, all of us needs clean air, right? But none of the market supplies the clean air, right? So this is an example of complete market failure. Next we have partial market failure. Under partial market failure, market is producing the product and supplying the product, but the product is supplied in wrong quantity and at wrong price in the market. It basically occurs in case of monopoly market. In case of monopoly market, we have already studied that the monopolist charges a higher price for the product, and also the monopoly does the underproduction of the product, right? Monopoly doesn't produce the optimal level of quantity of the product, right? Monopoly produces less than the optimal quantity of the product. So the monopoly market is the perfect example of partial market failure. So this is all about the complete market failure and partial market failure. Now students, we will talk about why do markets fail. That is, we will talk about the reasons behind market failure. So let's have a look. See students, there are basically four major reasons behind market failure, and those are: number one, market power; second, externalities; third, public goods; fourth, incomplete information. So we will study about all of these reasons one by one in detail. Students, let's first talk about the market power. See students, we know that in monopoly market, the monopolist charges the price for the product which is over and above the marginal cost of the product. So the monopolist is having the ability to charge the price for the product which is greater than the marginal cost of that product. This is basically called the market power, or you can say monopoly power. Okay, monopoly power also exists in different forms of market like monopolistic competition, oligopoly market also. But in monopoly market, the monopolist enjoys the highest market power as compared to the sellers of monopolistic competition and sellers of oligopoly market. But yes, the sellers of perfectly competitive market do not enjoy the market power at all, because the sellers in the perfectly competitive market are the price takers, not the price maker. Monopoly power is being enjoyed by those sellers who are the price makers, not the price takers. Okay, so market power or monopoly power leads to market failure. So let's go through the meaning of market power first. So basically the market power, or you can say the monopoly power, is basically the ability of the firm to raise its profitability level. Okay, and how it raises its profitability level? By charging the market price of a good or service which is over, or you can say above, its marginal cost. So let's recall it till now. Market power. Market power or monopoly power is the ability of a firm to profitably raise the market price of a good or service over its marginal cost. Now students, further we have that excessive market power leads to profits which are not achieved due to operating efficiency. These are basically those profits which are not achieved due to efficient utilization of resources, right? These are the profits which are achieved due to selling the products at higher prices. So that's why excessive market power leads to market failure, because here the market fails to produce the right quantity of goods and services and at the right price. Okay, so due to the excessive market power, the sellers are producing and supplying the wrong quantity of goods and services and even at wrong prices. So let's recall it. Excessive market power leads to profits which are not achieved due to operating efficiency. Thus, market fails to produce the right quantity of goods and services at the right price. Next we have externalities. As we have already discussed about externalities, see students, externalities also leads to market failure. Okay, and what do you mean by externalities? As already discussed, sometimes the action of one person creates the cost for other person. Okay, and sometimes the action of one person creates a benefit for the other person. Okay, so basically based on this, the externalities are of two types. First is negative externalities, next is positive externalities. Negative externalities refers to the action of one person creates a cost for the other person. Okay, for example, production by factories creates pollution for the other person, right? And next we have positive externalities. Positive externalities refers to that action of one person creates the benefit for the other person. Okay, for example, public parks creates a benefit for the people, that the people can go in the parks and do the exercises, can do the walk and enhance their health status, right? So basically externalities can be positive externality as well as negative externality. Negative externalities decreases the welfare, whereas positive externalities enhances the welfare. But the problem is that the cost and benefits which are created out of the externalities are not reflected in the market prices. That is, whenever the market prices are set for the goods and services, the cost and benefits created out of the externalities are not considered, which leads to market failure. Also students, externalities are known as spillover effects also, neighborhood effects also, and third party effects also, and side effects also. As externalities creates the effects, either the positive or the negative effect for other person who is not directly involved in the production or consumption of the goods. Okay, so that's why externalities are also known as spillover effects, neighborhood effects, third party effects, and side effects. So let's recall it till now. Externalities. Externalities are cost, that is negative externalities, or benefits, that is positive externalities, which are not reflected in market prices. Externalities are also known as spillover effects, neighborhood effects, third party effects, and side effects. Students, let's have an overview about the types of externalities. The externalities are basically classified into two, and those are production externalities and consumption externalities. Production externalities are those externalities, either positive or negative, which arises out of the production of goods and services. Whereas consumption externalities are those externalities which are either positive or negative and arises out of the consumption of goods and services. So basically we can say that production externalities are those externalities which initiates in the production of goods and services, which imposes an external cost on others, which may be received by others either in the consumption or production of goods and services. And consumption externalities are those externalities initiated in the consumption of goods and services, which produces external cost or benefits for others, may be received in consumption or production of goods and services. Okay. Let's talk about the examples of positive production externalities. See students, the firms who provides a benefit to their employees by providing the training to them, and when these employees switch their jobs, and the firms who hire such employees at the time when they switch their jobs gets a benefit for their training which were provided to them by their previous organizations, right? And another example of positive production externality is, let's suppose a person raises an attractive garden, okay, and those who pass nearby also watches that attractive garden and enjoy the garden, right? So that is also a positive externality, right? Now let's talk about the negative production externalities. See students, let's suppose there is a factory which produces the plastic, okay, and the waste which is generated out of the production of the plastic is charged by the firm in the nearby river. Now the people who consume the water of that nearby river get health disease, right? So this is an example of negative production externality. Also student, when the water of the nearby river is polluted now, so there will be less output of fish production over there, right? As there is loss of fish resources for them, right? So these are the examples of production externalities. Now students, let's talk about the example of consumption externalities. See students, there can be positive consumption externalities. For example, if people get immunized against a contagious disease, then it would create a social benefit which will prevent others from getting infected from that contagious disease, right? Let's talk about the negative consumption externalities now. The person who is doing the smoking will affect the other persons nearby, right? Basically, the other persons would be the passive smokers in this case and would get the adverse health ill effects. So this is all about the types of externalities. Now students, let's talk about how externalities leads to market failure. See students, we are already aware about the private cost and external cost. External costs are basically created by the externalities, right? So firms just consider the private cost, not they consider the external cost, okay, while setting the market price of the product. So basically we know that social cost is the sum of private cost and external cost. But firms only consider the private cost in their income statements in order to calculate the profit, right? But external costs are not included in firm's income statements or by the consumers for taking the consumption decisions. So neither the producer considers the external cost of producing the product nor the consumer considers the external cost of consuming the product. Okay. So let's recall it till now. Firms consider private cost but not external cost. Social cost is equal to private cost plus external cost. External costs are not included in firm's income statement or consumer's decision. And students, the market prices which are determined or you can say decided without considering the effects of the externalities, okay, or you can say without considering the social cost and benefits, then those market prices are not the ideal market prices, because these will lead to either the underproduction or the overproduction of the products. So let's recall it. The market prices determined without incorporating externalities are not ideal, as they do not reflect all social cost and benefits. Next, public goods. Now students, public goods also leads to market failure. Now let's understand who has given the concept of public goods and what is the meaning of public goods and how public goods leads to market failure. See students, the public goods was given by the economist Paul A. Samuelson. Basically, he was the first economist to develop the theory of public goods. Okay. He introduced the concept of public goods, or you can say collective consumption good. Basically, collective consumption good is the synonym of public goods. Okay. So, Paul A. Samuelson introduced the concept of collective consumption good, or you can say public goods, in his path-breaking paper which was published in the year 1954. Now, what do you mean by path-breaking paper? The paper which introduced something new in the market, okay, or you can say which introduced something new in the economy. So, Paul A. Samuelson introduced the concept of public goods in his path-breaking paper which was published in the year 1954, and the name of the paper was The Pure Theory of Public Expenditure. Okay. So let's recall it till now. Paul A. Samuelson introduced the concept of collective consumption good in his path-breaking 1954 paper. The Pure Theory of Public Expenditure is usually recognized as the first economist to develop the theory of public goods. Now let's understand the meaning of public goods. See students, there are basically two types of goods: private goods and public goods. Okay. Private goods are basically excludable and rivalrous. What does it mean? Private goods are excludable means that the person who is paying for the private good will be able to consume the private good, and the persons who are not able to pay the price of the private good, that is, who are not able to afford the private good, will not be able to consume the private good, right? For example, laptop. The persons who can pay the price of the laptop can consume the services of the laptop, right? And vice versa. Okay. So private good is excludable. For example, Apple. The persons who can pay the price of apples can consume the apples and vice versa. Next, along with the private goods are excludable, they are rivalrous too. Now, what do you mean by private goods are rivalrous? It means that the consumption of private good by one person prevents the consumption of that good by the other person. For example, if Mr. Ram is consuming an apple, then Mr. Sham cannot consume that same apple, right? So these are rivalrous in nature also. But it is not so in case of public goods. Public goods are non-excludable and non-rival. Let's take an example of public goods to understand it better. Parks, highways, national defense, etc. Students, public goods are basically those goods which are offered by the government to all the people living in the society. Okay? These are basically those goods which can be consumed by all the people living in the society. For example, parks, highways, national defense, etc. Now, public goods are basically non-excludable, which means that we cannot exclude any consumer from consuming the public goods, right? None of the person can be restricted to use the highways and national defense services, right? Because no one has to pay the price for it. So these are accessible to all the people living in the society. Next, non-rival. If someone is using a public good, then it doesn't reduce the availability of that good for consumption by others. For example, if I am using the park, then it will not reduce the availability of park for others, right? If I am using the street light, then it cannot reduce the quantity or the quality of street light for others. So it is non-rival in nature. Okay. So this is a major difference between private goods and public goods. So let's have a look on the meaning of public goods. Public goods are also known as collective consumption goods, or you can say social goods. Okay. These are basically those goods which are indivisible. Now, what do you mean by that public goods are indivisible? It means that all of us are consuming the same quantity of the public good. Public good is not divided into parts and then provided to the people, right? It is provided collectively and common to all the people living in the society. For example, parks, right? Next, non-rival, non-excludable, and enjoyed in common by all the individuals. Public goods are basically enjoyed by all the people together in the economy. So these are enjoyed in common by all people, all individuals living in the society, right? So same, park is same, and it is used by all the people living in the society, right? So public goods are enjoyed in common by all individuals. So let's recall it. Public goods or collective consumption goods or social goods are those goods which are indivisible, non-rival, non-excludable, and enjoyed in common by all individuals. Now students, we will see that how the public goods leads to market failure. See students, public goods are more prone to externalities and free rider problems. Now what do you mean by free rider problems? Free rider problem means since public goods are available at free of cost to all the people living in the society, so every person wants to extract more of it. Okay, let's suppose if in a park government has provided or has made available the gym machines. So since these gym machines are available to the people at free of cost, they do not need to pay the price for it. So these machines will not be properly utilized by the people, right? They will not keep these gym machines clean, okay, and use it in a proper way. Everyone would like to spend more time on the gym machines, which will lead to breakdown of these machines. So these are called free rider problems. Free rider problem basically arises because such goods are available to the people at free of cost. No one is paying the price to avail the services of the public goods. Okay. And moreover, everyone act in their self-interest. So all of this leads to free rider problems. Okay. So since public goods are non-excludable, so there is no incentive for people to pay for that good. Okay. So since public goods are non-excludable, that is, none of the consumers can be excluded from the consumption of such public goods. So no one is having any incentive to pay to consume the public good, right? No one would like to pay the price for the consumption of public goods. So let's recall it till now. Public goods are vulnerable to externalities and free rider problems. Since public goods are non-excludable, there is no incentive for people to pay for the good. Further, students, since for providing the public goods, the price is not charged, right? So producers are not motivated to produce a perfect quantity of such products. Basically, here we are talking about the private producers. Private producers will not produce any quantity of the public goods, right? Because they cannot charge a positive price for them, so they cannot make the profits from them. And we know that private producers always work for profits, right? So the producers will not produce a socially optimal amount of such products, or you can say of public goods. Okay. So let's recall it. Producers are not motivated to produce a socially optimal amount of products if they cannot charge a positive price for them or make profits from them. Okay. Also, these public goods are extremely valuable for the well-being of the society, right? If we talk about parks, these are valuable for the health status of the society, right? If we talk about legal services, it is valuable to provide the justice to the people living in the society. So all the public goods are basically very valuable to maintain the well-being of the people living in the society. But if it left to the market, or you can say private producers, then they will not produce at all, or you can say it will be underproduced, right? So thus there is market failure in the case of public goods, because such public goods are only provided by the government. None of the private sector is providing the public goods. So there is underproduction of public goods because there is only one producer of public goods, and that is the government. So let's recall it till now. Public goods are extremely valuable for the well-being of the society. Left to the market, there will not be produced at all. They will not be produced at all, or will be grossly underproduced. Thus, there is market failure in the case of public goods. Next, we have incomplete information. See students, market failure occurs because of the incomplete information also. We know that complete information is an essential feature, or you can say important feature or characteristic of perfectly competitive market, right? But in case of imperfect markets, there is incomplete information. Basically, incomplete information is also known as asymmetric information. Now, what is asymmetric information? Asymmetric information means that the buyers and sellers of the product are not having the same information about the product. Either the buyer is having the more knowledge about the product than the seller, or the seller is having the more knowledge of the product than the buyer. Okay. So asymmetric information is basically when the buyers and the sellers are not having the same knowledge about the product. Okay. So asymmetric information leads to adverse selection and moral hazard, which ultimately leads to market failure.
Now in the later phase of the video, I will let you know what is adverse selection and moral hazard. But for now, just remember that due to asymmetric information, there is adverse selection and moral hazard occurred in the market, which leads to market failure. Okay, it is basically due to the adverse selection and moral hazard. The market is not able to properly allocate the resources, which leads to market failure. Let's recall it. Incomplete information. Complete information is an essential feature of competitive market. Asymmetric information leads to adverse selection and moral hazard, which ultimately leads to market failure. Now students, what is asymmetric information? So as already discussed, asymmetric information occurs when there is imbalance in information between the buyer and the seller. So let's recall it. Asymmetric information occurs when there is imbalance in information between the buyer and the seller. Students, now we will discuss the meaning of adverse selection. Before going through the meaning of adverse selection, let's have a look on the example, which is basically the lemons problem. Lemons problem. It was developed by George Akerlof. Okay. This problem is in connection with the used cars market, or you can say second-hand cars market. Here, second-hand cars are called lemons, and the second-hand cars can be of low quality and high quality. Okay. So students, as we know that in the used cars market, the price for the car is paid by the buyers on the basis of the average quality, right? So the price of the second-hand cars, or you can say lemons, in the used cars market is decided on the average quality of the cars, right? That is on the basis of the brand of the car, on the basis of the model of the car, on the basis of the year to which that particular model belongs to, etc. Right? But the sellers which are having those second-hand cars whose quality is greater than the average quality would not get the fair price for their cars, right? Because the buyers would pay the price according to the average quality, but the quality of the cars of the sellers is greater than the average quality. So they will not get a fair price of their cars. So such sellers do not sell high quality cars to the buyers who are the strangers for them. They basically sell such quality cars to their relatives or friends instead of selling it to the stranger buyers. So this is the reason that there will be elimination of quality cars, okay, or you can say high quality cars from the used cars market. So this is called adverse selection. Adverse selection occurs whenever the buyers and the sellers do not have the same knowledge about the quality of the product. Here in this example, the seller is having the proper knowledge about the quality of his product, but the buyer is not having the knowledge about the quality of the product that the seller wants to sell, right? So the buyer is not like to pay more price to the seller because he only pays the price according to the average quality. So this will eliminate the high qualitative cars from the used cars market. This is called adverse selection. So adverse selection is a situation in which asymmetric information about quality eliminates, or you can say removes, high quality goods from the market. So let's recall it till now. Adverse selection is a situation in which asymmetric information about quality eliminates high quality goods from the market. Now students, we will discuss about the moral hazard. So let's first look at the example. Mr. Ram has taken the medical insurance, okay, and he now admits in the hospital, and he less cares about the excessive fees charged by the doctors, unnecessary medical treatments which are costly, unnecessary medical treatments which are costly, okay. So after taking the insurance policy, or you can say after taking the medical insurance policy from the insurance company, Mr. Ram is showing his careless behavior. It is because the overall cost of the medical treatment of Mr. Ram will be borne by the insurance company now. So here Mr. Ram is taking the advantage of the insurance company, which is not able to observe the actions of Mr. Ram, right? So it is because of the unobserved action of insurance company, or you can say less informed person. Here less informed person is the insurance company, because the insurance company cannot see the behavior of Mr. Ram, or you can say cannot observe the behavior or the actions taken by Mr. Ram, right? So Mr. Ram is taking the advantage of the situation of the insurance company, right? So due to such behavior of Mr. Ram, the insurance premium will rise for all the people, and the potential customers in the market for such insurance premium will reduce, right? So this is called moral hazard. Moral hazard is basically when an informed person takes the advantage of less informed person through an unobserved action. Okay. So let's recall it. Moral hazard is opportunism characterized by an informed person taking advantage of a less informed person through an unobserved action. So asymmetric information, adverse selection and moral hazard affects the ability of markets to efficiently allocate resources. Market will fail to allocate the resources properly due to asymmetric information, adverse selection and moral hazard, and this will lead to market failure. Because the party with better information has a competitive advantage over the party which have lesser information. So let's recall it. Asymmetric information, adverse selection and moral hazard affect the ability of markets to efficiently allocate resources and therefore leads to market failure, because the party with better information has a competitive advantage. So students, till now we have discussed that there are 4 major reasons about market failure. Basically, market failure occurs whenever the market is not able to allocate the resources properly. And secondly, there are various reasons behind market failure, and those are: number 1, market power, or you can say monopoly power; number 2, externalities; number 3, public goods; and number 4 is asymmetric information, or you can say incomplete information. Now, to protect the market from failure, the government intervenes in the market. So in our video, we have gone through the reasons behind market failure, and those reasons were monopoly power, or you can say market power, externalities, public goods, and incomplete information. Now students, we will see that how the government intervenes, or you can say how the government interferes in order to check the market failure, or you can say in order to control the market failure. Okay, so let's have a look. So first we are going to talk about the steps which are being taken by the government in order to minimize the market power. As we all know that market power is the reason for market failure. So if the government will be able to minimize the market power, then the government will be able to minimize the market failure. Okay, so let's have a look on the steps which are being taken by the government to minimize the market part. So first, the government has made various rules and regulations in order to check the anti-competitive actions taken by the firms. For example, Competition Act 2002, which is amended by the Competition Amendment Act 2007. Basically, this act focuses on promoting the fair competition among the firms by preventing the anti-competitive actions by any of the firm involved in the market. Okay, so let's recall it till now. Government intervention to minimize market power. Various rules and regulations are designed to check anti-competitive actions. For example, Competition Act 2002 as amended by the Competition Amendment Act 2007. Further, we have the government has made various rules and regulations to control on mergers and acquisitions if there is possible market domination. If any merger or acquisition leads to market domination, then the government has rules and regulations in order to control those. Okay. Next, the government uses the price capping and price regulation. Now, what is price capping? Price capping means setting maximum limit on prices charged by the firms for selling their goods and services. Okay. So this is done in order to prevent the selling of essential goods at a very high prices on which the people cannot afford those. Okay. So price capping is generally done in case of necessities or in case of utilities. Next, we have price regulation. Price regulation involves price ceiling and price floor. Price ceiling is setting the maximum limit for the prices to be charged by the firm for selling their goods and services, whereas price floor is setting the minimum limit for the prices to be charged by the firms for selling their goods and services. Okay, so let's recall it till now. Controls on mergers and acquisitions if there is possible market domination. Next, price capping and price regulation. Now further, the firms regulate the profit or rate of return. So there is profit or rate of return regulation also. Under this, the government sets the limit for the amount of profits that can be earned by the firms. Okay. So basically the government sets a specified rate of return on the capital employed by the firm. Okay. Next, patronage to consumer associations, that is giving the financial and legal support to organizations that works in the interest of the consumers. So let's recall it till now. Profit or rate of return regulation, patronage to consumer associations. Now further we have tough investigations are conducted by the government into cartelization. Now what is cartelization? Cartelization means when competing firms combine together in order to manipulate the prices in order to drive the benefits of monopoly. Okay. So tough investigations are made by the government in order to prevent cartelization and unfair practices such as collusion and predatory pricing. Predatory pricing means when a dominant firm sets the price in such a way in order to prevent the competitors in the market. Okay. Next, reduction in import controls. Here the government takes the steps in order to enhance the imports also. The government basically reducing the restrictions on the import of goods and services by reducing the tariff rates and removing the quotas. Okay. Next, nationalization. Now, what is nationalization? The government is taking the control over the private assets so that the social welfare can be increased and anti-competitive practices can be avoided in the market. So let's recall it: tough investigations into cartelization and unfair practices such as collusion and predatory pricing. Reduction in import controls. Next, nationalization. Also, students, the government is taking the steps to protect the intellectual properties of the individuals by providing the patent and copyright. This is one of the incentives which are given by the government to promote the innovation and invention. Also, the government is allowing the natural monopoly. Now, what is natural monopoly? Natural monopoly means where a single firm is able to supply the goods and services efficiently in a particular location, then the combination of two or more firms can do. Okay, so that is a natural monopoly. This basically occurs in case of electricity supply, in case of water supply. Okay, natural monopolies are arising due to the huge fixed cost involved in it. So let's recall it till now. Government provides patent and copyright to provide incentive for innovation and invention. Permitted natural monopoly. Now, students, we will talk about the government intervention to correct externalities. That is the steps taken by the government in order to check the effects of externalities. Okay. So, government initiatives, that is the steps of the government towards correcting the negative externalities, are classified into two, and those are: number one, direct controls, which are also known as command solutions, and number two is market based policies. Under direct controls, or you can say command solutions, the government takes the steps directly for the people who are engaged in creating negative externalities. Okay. And market based policies includes the subsidy and tax policies used by the government for correcting the effects of negative externalities. So let's recall it till now. Government intervention to correct externalities. Government initiatives towards negative externalities are classified as: A. Direct controls or command solutions. B. Market based policies. So first we will talk about the direct controls in details. So as already discussed, direct controls are basically the regulations, that is the rules and regulations that openly regulate, or you can say that openly control the actions of those who are directly involved in generating negative externalities. Okay. So, for example, through legislation, that is the legal rules and regulations, the government can fix emission standards. That is, the government can fix the legal limit on how much a firm can generate the emissions, or legal limit on how much a pollutant a firm can emit. Okay. So let's recall it. Direct controls. Direct controls are regulations that openly regulate the actions of those involved in generating negative externalities. For example, through legislation, the government can fix emission standard, legal limit on how much pollutant a firm can emit. Further, smoking is completely banned in many public places by the government, right? And stringent rules, that is the strict rules, are there in respect of tobacco advertising, packaging and labeling. For example, on tobacco, warning label is important, and the companies who are engaged in the production of tobacco and are doing the advertisement of tobacco are basically always mentioning that tobacco is injurious to health. On the packets of cigarettes, we have warning label also that smoking is injurious to health, right? So these are certain rules that the companies need to follow. So let's recall it till now. Smoking is completely banned in many public places. Stringent rules are there in respect of tobacco advertising, packaging and labeling, etc. Now there are various laws like the Environment Protection Act 1986. The Environment Protection Act 1986, as the name suggests, it promotes the protection of the environment from the unfair human activities. Also, there are certain laws related to licensing, production quotas and mandates, etc., which are made by the government in order to prevent the negative externalities. So let's recall it. Various laws like the Environment Protection Act 1986, licensing, production quotas and mandates, etc. Also, the government can also form special bodies to address the problems related to the creation of negative externalities like the Ministry of Environment and Forest, the Pollution Control Board of India and the State Pollution Control Boards. Okay. So the government can also form special bodies to address the problem like the Ministry of Environment and Forest, the Pollution Control Board of India and the State Pollution Control Boards. Now we have market-based approaches. So as already discussed, under market-based approaches, the government uses the tax and subsidy policy in order to change the behavior of market participants who are creating the negative externalities. So let's recall it, market-based approaches. The government tries to alter the prices of goods through taxes and subsidies and thus change the behavior of market participants. So basically through taxes and subsidies, the government can change the prices of goods in order to change the behavior of market participants. This is all included under market-based approaches. This is achieved by setting the price directly through a pollution tax. The government charges the pollution tax from the firms who are involved in generating the pollution. Okay, so this is basically setting the price directly through a pollution tax. Next, setting the price indirectly through the establishment of cap and trade system. Now, what is cap and trade system? We will discuss it later. So, second way is setting the price indirectly through the use of cap and trade system. So, let's have a look first on the pollution taxes. See students, one method of ensuring internalization of negative externalities is imposing pollution taxes. Now, what do you mean by internalization of negative externalities? See, as we have seen earlier, that the effect of cost created by the externalities are not considered by the firm in their income statements. So this is called that there is no internalization of negative externalities. So this is the reason that firms are doing overproduction of those goods which are creating the negative externalities, because these firms are not considering the external cost involved in production of such goods in their income statement, right? So if they will be able to internalize the negative externalities, then they will be able to produce the optimal quantity of such goods. Okay. So here pollution taxes is being applied by the government so that the firms are able to internalization their negative externalities. Okay. Pollution taxes are named after A.C. Pigou, and that's why these are also known as Pigouvian taxes. So let's recall it till now, pollution taxes. One method of ensuring internalization of negative externalities is imposing pollution taxes. Pollution taxes are named after A.C. Pigou. These are also known as Pigouvian taxes. Also students, the size of tax, or you can say the amount of tax, is dependent on the amount of pollution a firm produces. The firm who is producing the more amount of pollution will be taxed more as compared to the firm who is producing less amount of pollution. These taxes have the effect of making the polluter pay, right? So through pollution taxes, whatever cost is created by the firm due to the pollution is borne by the firm itself, that is the polluter itself. So these taxes are based on the effect of making the polluter pay. Tax increases the private cost of production or consumption. So here, tax being a part of their internal cost, now they are considering the taxes as a private cost of production or consumption. And since the firms are considering now the pollution taxes in their private cost of production, so now they will decrease the quantity produced by them, that is the output of the good. And those who are consuming the goods and services which are creating the pollution will decrease the quantity demanded also, because the burden of such pollution tax will be definitely charged from the consumers. Okay, so the effect of tax is that the tax increases the private cost of production or consumption, that would decrease the quantity demanded and the output of the good. So let's recall it till now. The size of tax depends on the amount of pollution a firm produces. These taxes have the effect of making the polluter pay. Tax increases the private cost of production or consumption and would decrease the quantity demanded and output of the good.
Students, there are certain problems in administering an efficient pollution tax. Why it is so? Because pollution taxes are difficult to determine and administer. Basically, pollution taxes are difficult to determine. It means that it is very difficult to set the amount of pollution taxes that to be charged from the firms. Okay? And it is very difficult to determine the environmental impact of the pollution and the compliance of the pollution taxes. So let's recall it till now. Problems in administering an efficient pollution tax. Pollution taxes are difficult to determine and administer. Moreover, if the demand for the good is inelastic, then the producers will be able to easily shift the tax burden in the form of higher product prices on their customers, right? And as a result of that, the pollution tax burden which is shifted from the producers to the consumers will reduce the demand for the product. So let's recall it. If the demand for the good is inelastic, then the tax may have only an significant effect in reducing demand. The producers will be able to easily shift the tax burden in the form of higher product prices. Also, students, pollution tax have potential negative consequences on employment and investment. Let's know it how. See students, if in a particular country there are very high pollution taxes, then the producer will shift the production facilities from that country to any other country where there are lower pollution taxes. Okay. So it will reduce the employment and investment in the countries with high pollution taxes. So let's recall it. Pollution taxes also have potential negative consequences on employment and investments, because high pollution taxes in one country may encourage producers to shift their production facilities to those countries with lower taxes. Now we will talk about the cap and trade system. Under cap and trade system, the government uses the tradable permits to limit the emissions. Okay. So basically this is the second approach to establish prices indirectly using the tradable emissions permits. So let's recall it till now. Cap and trade system. The second approach to establish prices indirectly is tradable emissions permits. The use of tradable permits to limit emissions is often called cap and trade system. Now what is tradable permit?
tradable permit is basically a license that allows a company or permits a company to release or discharge a unit of pollution into the environment over a period of time. Okay. So let's recall it. A tradable permit is a license, that is a written permission that allows a company to release or discharge a unit of pollution into the environment over a period of time. So this license is related to a period of time. Also, by issuing a fixed number of permits, the government determines the total level of pollution that can be legally emitted during each period. And that is called the cap. The cap is basically the total amount of pollution or the total level of pollution that can be legally emitted during each period. Okay. Now the firms has permits specifying or mentioning the number of units of emissions that a firm is allowed to generate. Okay. So let's recall it till now. By issuing a fixed number of permits, the government determines the total level of pollution that can be legally emitted during each period, that is the cap. The firms has permits specifying the number of units of emissions that a firm is allowed to generate. Now further we have a firm that generates emissions which is above what is allowed by the permit. Then that firm is penalized for it. Large fines are imposed on that firm which is generating the emissions which is above the level of emissions which is being allowed to the firm to release. Okay. Now since these permits are tradable, that is these permits can be easily sold and purchased from the market. So high polluters have to buy more permits, right? Which increases their cost and makes them less competitive and less profitable. So let's recall it. A firm that generates emissions above what is allowed by the permit is penalized with substantial fines. Since permits are tradable, so the high polluters have to buy more permits, which increases their cost and makes them less competitive and less profitable. And the low polluters receive extra revenue from selling their surplus permits, which makes them more competitive and more profitable. Thus, firms will have no incentive to pollute. So let's recall it. The low polluters receive extra revenue from selling their surplus permits, which makes them more competitive and more profitable. Thus, firms will have no incentive to pollute. The cap and trade method is comparatively cheap and simple to implement as compared to pollution taxes. And the cap and trade method ensures that pollution is minimized in the most cost effective way. So let's recall it till now. The cap and trade method is administratively cheap and simple to implement and ensures that pollution is minimized in the most cost effective way. Now students, we will talk about the government interventions to promote positive externalities. That is steps taken by the government in order to promote the positive externalities. Subsidies are provided to the producers to enhance the supply of the good, which generates the positive externalities. Through subsidies provided by the government to the producers, the cost of production of the goods which generate the positive externalities will reduce, and the profitability level of such producers which are engaged in production of those goods which generate the positive externalities increases, and hence they will supply more quantity of that good. And subsidies to consumers can also be provided in order to increase the demand of the product in the market. For example, subsidies are provided on LPG cylinders by the government in order to increase the demand of such products in the market. So let's recall it till now. Government interventions to promote positive externality. subsidies to producers to enhance the supply of the good, and subsidies to consumers to increase the demand of the product. Now further we have the government also itself produces and supplies that products which have vast positive externalities. For example, public education which is provided by the government schools, public medical services which are provided by the government hospitals, etc. So the government itself produces and supplies that products which have vast positive externalities. The government itself produces and supplies the vaccines for coronavirus, right? Now we will talk about the government intervention in the case of merit goods. Now what are the merit goods? Merit goods are those goods which generate the positive externalities for the people, right? But merit goods are underproduced and underconsumed. Now to enhance the production of the merit goods and to enhance the consumption of the merit goods, the government takes various steps such as regulation. The government frames the rules and regulations in order to increase the production of merit goods and in order to increase the consumption of merit goods. The government provides the subsidies on the production and consumption of merit goods in order to increase the production and consumption of merit goods. The government provides direct government provision. That is, the government itself produces and supplies the merit goods so that most of the citizens can take the benefit of merit goods, and a combination of government provision and market provision. Sometimes the government and the private sector combines themselves and provides the merit goods to the people together. Okay. So let's have a look. Government intervention in the case of merit goods. Merit goods are underproduced and underconsumed. The possible government responses are regulation, subsidies, direct government provision, and a combination of government provision and market provision. Also, regulation determines how a private activity may be conducted. For example, the government regulates the actions of the private schools, right? The government regulates how the education is provided to the people living in the society. Also, the government may compel individuals to consume goods and services that generates external benefit. For example, the government may compel the individuals to get immunized against coronavirus, right? So let's recall it till now. Regulation determines how a private activity may be conducted. Government may compel individuals to consume goods and services that generates external benefit. Also, ultimately, encouragement to consume is to make the good completely free at the point of consumption. Basically, the government provides those goods free of cost to the consumers, which encourages the consumers to consume those goods properly. For example, free vaccinations of coronavirus provided by the government, right? So that encourages the people to get immunized against the coronavirus. The free medical treatment provided by the government through government hospitals encourages the people to get the medical treatment for the disease that they are having. So let's recall it. The ultimately encouragement to consume is to make the good completely free at the point of consumption. Now students, let's look at the government interventions in the case of demerit goods. That is the steps taken by the government in the case of demerit goods. Now students, we believe that demerit goods are basically those goods which are believed to be socially undesirable. That is those goods which brings negative consequences for the society, and basically these are those goods which the people in the society consume and they creates negative externalities for other people living in the society. For example, cigarettes, alcoholic products, etc. Okay, but it should be kept in mind that all goods with negative externalities are not essentially the demerit goods. For example, production of steel leads to pollution, right? But steel is not a socially undesirable good, right? So let's recall it till now. Government interventions in the case of demerit goods. Demerit goods are goods which are believed to be socially undesirable, for example cigarettes, alcohol, etc. It should be kept in mind that all goods with negative externalities are not essentially demerit goods. Now further we will look at the steps taken by the government to correct market failure which arises due to demerit goods. See, there is complete ban on the demerit goods. For example, very intoxicated drugs, right? Those are completely banned by the government. So complete ban on the demerit good. And also the government is trying to making people aware through negative advertisement campaigns, right? Government is spending a lot of money in order to do the advertisements which shows that smoking is injurious to health, consuming alcohol is injurious to health, right? So the government is spending a lot of money in order to make the people aware about through negative advertisement campaigns. So let's recall it till now. Steps taken by government to correct market failure. Complete ban on the demerit good, making people aware through negative advertisement campaigns. Also, the government has made certain rules and regulations in the form of spatial restrictions. Now what is spatial restrictions? These are restrictions on location, space, etc. For example, alcoholic shops should not be located nearby any school. Okay. So regulatory controls in the form of spatial restrictions are there. Next, higher rates of taxes are imposed on the demerit goods or on the socially undesirable goods. So higher rates of taxes are imposed on cigarettes, alcoholic products, which increases the price of these products. And so the higher tax rates leading to increase in price of such goods proves as a disincentive to purchase these goods by the consumers. Next, fixation of minimum price. Minimum price limit is being fixed for such products by the government. The regulatory controls in the form of spatial restrictions, imposing higher rates of taxes, fixation of minimum price. Students, now we will discuss about the government intervention in case of public goods. That is the steps taken by the government in order to minimize the market failure which arises due to the public goods. So first we have is direct provision of public goods by the government. Basically, the government itself produces and supplies the public goods to the people living in the society in order to overcome the problem of free rider, that is the free rider problem, which leads to market failure. For example, the government provides the defense services, legal system services, etc. So let's recall it till now. Government intervention in case of public goods. Direct provision of public goods by government can help overcome the free rider problem which leads to market failure. For example, defense, legal system, etc. Also students, the public goods which are of excludable in nature, that is the public goods for which the government charges a nominal amount, for example parks with the entrance fee, museums, etc. These are provided by the government and the expenses of such goods are financed by the government through entrance fee. So the government may provide this to the private sector also. So the government can do the privatization of such excludable public goods. That is, the government can provide the licenses to the private firms in order to build a public good facility and charge fee from the users. So let's recall it. Excludable public goods such as parks, museums, etc. can be provided by government and the same can be financed through entrance fees. Government may grant licenses to private firms to build a public good facility and charge fee from the user. facility and charge fee from the user. Now students, we will talk about the price regulation, that is price intervention by the government, that is non-market pricing. See, we have already talked about this price controls. Government can levy the price controls basically. So government levy the price controls in the form of two: price floor and price ceiling. Under price floor, the government fixes the minimum price of the products and services which can be charged by the firms. Okay. And under price ceiling, the government sets the maximum price for the goods and services which can be charged by the firms from the consumers. So let's recall it: price intervention, non-market pricing. Price controls, it can be in the form of price floor and price ceiling. Under price floor, minimum price is set for the goods and services, and under price ceiling, maximum price is set for goods and services. Also students, as we know that incomplete information also leads to market failure. So there are steps which are taken by the government in order to correct the information failure, that is the market failure, which is the outcome of the incomplete information. So let's talk about the government intervention for correcting information failure. So government has made certain rules and regulations which makes labeling and content disclosures important by the producers. For example, warning signals on cigarette packets. On every packet of the cigarette, it is written that smoking is injurious to health, which is a warning label. And why it is written? It is done in order to it is done due to the government rules that makes it important that warning labels must be there on cigarette packets. So let's recall it till now. Government intervention for correcting information failure. Government makes it mandatory to have accurate labeling and content disclosures by producers. For example, labeling on cigarette packets. Some other examples are: ingredients on the food items must be labeled on the packets of the food items. Now further we have mandatory disclosure of information, that is the necessary disclosure of information, and regulations of advertisements and setting of advertisement standards. Basically the government has made certain rules and regulations regarding the advertisements and regarding the advertisement standards, which makes advertisement more responsive and informative rather than persuasive. Okay. So let's recall it till now. Mandatory disclosure of information, regulations of advertising and setting of advertising standards to make advertisements more responsive, informative and less persuasive. Now we will talk about the government intervention for equitable distribution of income and wealth. So following are the steps taken by the government to attain equitable distribution of income and wealth. Progressive taxation policy, unemployment compensation, job reservations, social security schemes. So all of this we have already studied. So this is all about the government intervention in order to correct the market failure.